That is the key of trading.
So hold on. That was the most interesting thing ever. When I started, I was losing my own capital. I can tell when a trader is very inexperienced when they ask me, what do you think the market's going to do next? You think I have I have no clue.
So did I know Tesla was going to go from 200 to 500 in 2 months? No.
No, of course not.
No. If I would have known that, I would have bought a whole lot more, of course.
It's like trading is not about being right.
When you take back and you realize with 1 to 2 risk reward, you only need to be right X% of the time.
If you have your system, you stick to your system.
And you stick to it. Because you need to understand how to make money first.
And that's the part of it is you show up, you execute your strategy and your process. And this is what I found is like, yeah, those 100,000 days come, but it doesn't come by randomness. It comes because you show up and you do the same thing every single day.
Talk a little bit about how you're doing that and what is it that you're doing that's so unique? Because I don't know that there's another trader in our little small Discord trading signals room industry that does what you do.
So talk about that just a tiny little bit because I might make some trading decisions after this. No, seriously.
The crux of my approach is finding what nobody else wants. Use other people's money to learn how to, like, it is the highest reward, lowest risk type proposition out there.
A lot of traders come into our group and they're like, what was the aha moment? What was it for you that clicked? And I always tell them, it's not one singular moment that happens. It's not one aha moment. It's good habits that we stack on top of each other.
But if you want to make 10,000% gains, like, I'm sorry to break it to you, it does not exist. And a lot of people, there's a lot of money to be made telling you that it does exist.
Right.
So much of this data is just out there, right? It's just like knowing where to look. And I think that's what we help a lot of people with is like,
we're just going to teach you what's important and we're going to guide you on the path and hopefully shorten that learning curve for you to find what works for you.
So that's trading. Bada bing, bada boom.
And wrong.
Start.
We're here in Dallas, Texas, the HighStrike trading team, currently looking at the market. What we saw during the last Trump presidency for the guys that were around, the VIX it remains in an elevated state when he's president because the market's trying to figure out, okay, what can this guy tweet at any given second that's going to cause a 2 to 3% move in the indexes. So it's just, we're in this kind of landmine zone of where anything could set off volatility at any moment. What we've seen.
This is not different than its first administration. No,
it's the same thing.
It's the exactly same dynamic
thing. But the market got very used to what was happening under the last, where there was no volatility. You look at the VIX under Biden, it was just very slow, predictable. They kind of had, I would imagine there was some kind of VIX control going on, some kind of false because there was no volatility at all. So we go from this like suppressed state on the VIX where price action is very slow, methodical. This is what I was talking about with our alpha guys this week. Is like the best time for your trading futures is when price is just kind of stair stepping in a traditional way, right? Like you just get those easy days where it's just like, all right, we're going up 1%, down 0.25%, and just kind of stair step up. All the traditional lines of support and resistance is just behaving in a very normal, orderly fashion. And then you get the Trump presidency where he's tweeting about tariffs, he's tweeting about XYZ, and the volatility just wake. Nobody knows how to react to it. The market, it's used to it. Like it's been a long period of just methodical, slow grind up. Now, this isn't to say that we're just going to go to zero. It's just telling you to expect wider ranges going forward,
right? Which
was norm during his last presidency. But you like as traders, you fall into this kind of you project on what happened recently to expect it to happen in the future, and it's always going to remain dynamic and changing and adapting to new circumstances, which we've obviously seen this year as things go.
And that speaks to trading psychology, doesn't it? Because I don't know about you guys, but I fundamentally am a bullish trader. I'm generally looking for long trades. So being exhausted here to the downside, you said something that I thought was interesting. An 80-point candle. If you're expecting a run to the downside, you killed it in the last 4 weeks. You literally killed it. But I don't think fundamentally I don't know about me. I'm not really a short trader. I don't make the majority of my money on shorts. I don't know about you guys. Do you guys?
Yeah, my statistics, I'm closer to 50-50, but yeah, I was just caught off sides this week with the volatility. And we want volatility as day traders, right? Like
we do.
Yeah. We have some traders in our community who made a lot of money this week because they were on the right side of it. They made the adjustments that I just made quick enough. But volatility is a good thing for us. It's those 1 point swings intraday is absolutely dynamic and we love it and we want it, but you just got to be prepared for it.
So that's what I was alluding to. Everyone feels exhausted, myself included, just because our bias was wrong and we keep on getting stopped out. So that 80-point candle on the 1 minute or 3 minute time frame is actually a great thing if your bias is correct and if you have the right risk reward. But that's why I feel that everyone as traders, at least in my opinion, even in the crypto market, you feel exhausted because you're not on the right side of that trade, right?
Yeah. Absolutely. And Friday, before we flew down here to Dallas, Shane and I were on audio on Friday, and I signaled a long position, and it happened to go 140 points in minutes. And as some of our that thing went so fast, I couldn't catch it. I'm like, yeah, volatility, we was on the right side of it finally. So I got to reap some of the rewards finally. And so, yeah, you just got to be prepared for it. And you have to get your risk management, which is something we preach about on a daily basis in HighStrike, is yes, it's volatile, but we don't deviate away from proper risk management, because that's what it all boils down to in what we're teaching.
And I'm pretty sure not just in our Discord or just traders in general, 90% of the time we're sitting on the 1 minute or 3 minute chart and we're bitching about something not happening, right? So when it does happen, we get thrown sideways, right? It's like we were waiting for it.
Yeah, you were begging for something to happen, that it just did happen in the direction.
You weren't at the plate, so you couldn't take the pitch.
And that's where the majority of traders, they get pissed off. They're either oversized because they were on the wrong side. Because fundamentally, I think that the majority of traders are generally looking for the long side trade, because that's where the risk reward is. What's the reward for the downside?
To go up over time for you know what I mean? So like
I think about it
rare
like this.
pockets in time where you catch these big down moves, but when you do, I mean, I didn't catch it, but when you do catch these kind of moves, you capture that kind of volatility. I caught the VIX pre-COVID, and it was one of the most wildest trades of my life, and I've never been able to recreate that to the short side.
Okay,
probably ever again.
Yeah, okay. Let's talk about that trade, because it's pretty wild. We know the trade, but tell the story, please.
So this was February of 2020.
Okay, let's all pull up our charts.
So right after I just I started trading equity options in 2018. I started to really get into it. And at this point, I remember I was buying Tesla calls, and it was just like I was long Tesla calls and Amazon. And the type of gains I was seeing on those calls, it was just like I didn't have as full grasp of the dynamics as I do now. But I saw it and I was like, all right, this is abnormal. Like just thousands of dollars just pouring in. And I was like, something seems wrong here, right? Like you're just making way too much money way too quickly. And I was like, I should probably hedge this in some manner or fashion. So I was looking at the VIX, and obviously knew like, okay, there was all these kind of warning signs before COVID that like, hey, China's like totally locked down. Like how is this good for the world economy? That's it. Like you have this divergence where half of the world is shutting down. Then the other side of it, I'm making $10,000 down out of the money Tesla calls.
Just blindly making it.
I was like, I traded it like I know what I'm doing, but at the same time, this is a little bit irrational. So I looked at the VIX, and I picked up some VXX calls. I think they were at like the 15 strike. And then it was just like, then like within, I think it was a Friday. So let me look at the chart here. So I think it was somewhere around the closing week on February 24th, I entered that trade. And then it just went, and I think like 2 weeks later, then like bad news after bad news started coming out. Trump shut down the economy. And when I woke up the morning and checked my account after Trump made the announcement, like I could not believe because like, and that kind of wired me into the way that I learned to trade now, is like the probabilities in the options market are, when you are shorter dated, they're extremely accurately priced. So if you're looking at something on a 1 to 2 week, 0 DTs and whatnot, like they're designed for you to lose because they're the pricing couldn't be any more accurate. But when you go out further, they're not priced for the tails, right? So like you have tail risks in both ends. And that situation in 2020, I just like at that point, like the VIX started to go up. So I was making money on on the VIX calls I had. So I was like, well, let me look at deep out of the money puts on everything. And they were just there for like 10, 20 cents a contract. So I was like, let me buy some of these, because I didn't want to close out this long call.
Blindfold, throw a dart, you're going to make money.
Get really bad really quick, and they're just giving away, it's essentially insurance policies, right? So you buy the insurance before, it's like buying insurance before a hurricane, and then a hurricane comes and there's a shortage of insurance policies out there and they have to buy them from you, right? So I was like, kind of like, this is where I started to really piece together that kind of methodology. And I was like, well, they're just giving away these insurance policies, and if this is as bad as it looks at the moment, this could get pretty slippery pretty quick. No. Was I expecting everything to go limit down for the next 2 weeks? No. But it's like you look at those probabilities, and I was like, well, this seems like a kind of easy layup potentially. Then yeah, it was just, I think, one of the most insane periods ever.
I think about that strategy and piecing it together almost like playing the lottery, right? Mm-hmm. where
The odds are in your favor.
I'm looking at the VIX now, and I'm looking at, particularly for that moment in time, it spikes above, let's say, 50. Doesn't really do that too much in a decade, but I was thinking about that particular trade.
So once in a decade type trade.
So how much did you make on that trade? How much did you put down? How much did you make?
I think it turned like 13,000 into 550.
Did you clean that plate off or no?
Yeah.
All right. So you took that.
It was in a retirement account.
Cool.
So you're not the tax benefits that come from that too. That's beautiful.
That's the story about financials advisors that we were talking about earlier.
So, all right. So the VIX was trading at around what, 18 around that period?
Let me look at it.
Because I'm looking at that now, because I'm thinking about how this can be applied to just the trading methodology that you have now. Buying traders do this all the time. You buy four out of the money contracts on SPY or QQQ, and then you just wait for it to hit. And it's about hitting maybe 5-10% of the time. But when you do, you hit big.
You have to have that methodology behind it. Like you can't just throw darts blindly, right? Because if you just throw your money at something because you're like, oh, well, it's going to go up. Yeah, like you have to be able to kind of forecast those future events where it's like, okay, well, what if a tail risk is going to happen in one direction or the other, has to be a catalyst, right? And you kind of have to look down the pike and see, okay, well, what catalyst could happen that haven't happened yet in the market?
Understood.
Right? What could change it? So if you're looking at like NQ now, right? I'm looking at it on the daily chart. It's gone down in a straight line for 2 weeks straight. Almost never do you see this, right? So the odds of that, what happens is you get like this kind of rolling boulder in one direction. Now it can get a lot more insane, but all it's like the deeper it goes, the bigger that's
Absolutely.
Right?
Absolutely.
That rubber band gets pulled back. So if you looked at Nat, like looked at out of the money calls in say end of April, June, etc., you go out like a month, 2 months. What are the odds of there being some kind of reversion, like 1,000-point candle in the opposite direction? What happens when there's a 1,000-point candle in the opposite direction? All of those out of the money call premiums go through the roof because the market's totally off sides in one direction. So it's like zigging when everybody zags. What threw me off in February there before we had this down is that the VIX was already high. So like I didn't see where I made my mistake is actually the market was preparing for this, and I thought it was more like it was already priced in to some extent because we had like the deep sea candle down, we had that big drawdown. We kept having repeat 1,000-point moves to the downside. And I was like, all right, well, maybe this is the setup here where they're finally going to squeeze it, break above the all-time highs because we kept having those rejections to break lower. It kept going up. So the VIX was already in an elevated state before we started crashing. And this is just one of those instances where it's like the real opportunity to go long VIX would have been something like in August, right? So VIX was at like 12. The market was overexhausted at all-time highs. If you looked at like the Emerson Mail and NQ and ES back in late July, it couldn't go any higher. It was every possible catalyst the upside was already exhausted. Everybody could possibly buy tech stocks and running. Everybody was in it.
Yep.
Who's the marginal buyer? But something's that extended. Like
It's usually the retail traders.
there's no more upside to be had when something's at daily RSI of what was it in July?
I think it was close to 70, 75.
It was at 85.
85. Okay.
85 in July. It's at all-time highs. VIX is at 12. So that's a scenario where you can look at it and be like, all right, well, you have to also understand the dynamics in options pricing. Institutions are constantly long everything, right? So they have billions of dollars of long positioning in their portfolios. The way they protect that is they sell out the money calls. They take that premium and buy puts. So puts are always more expensive versus calls because of that. So more often than not, your opportunities to capture big gains are going to be on the call side because it's always suppressed because of that oversupply of call writing from institutions who hold a lot of money.
So hold on. That was the most interesting thing ever. Let's recap on that, because generally people want to buy puts because they are explosive and they happen very quickly. It's like it's lightning hitting, right? Yeah. But what you're saying is, since we're all already engaging here way to the downside, you're not calling a bottom. That's not what you're doing. But what I was just looking at, specifically with the VIX comment that you made, but more so here with the indexes, buying a 700 call out into December for SPY, it looks like it's running you about $1.50.
Yeah,
right? So that $1.50 can be what? What can that turn into? $35. All right.
Let's look at the historical pricing of it. So this is one of my favorite ways to look at options pricing, right? Is you look at it no different than a price chart. So I'm going to follow that SPY 700 call here.
And you share these often in our group during the morning audios. And
so those of you that are watching, pay attention to this, because this is not Shane getting lucky. This is strategy, and it's a pretty efficient one. So it's kind of fascinating, right?
I'm looking at the January 2026, actually, 700 call and SPY. It's at $1.94 now.
Right.
If you would have looked at this in November, obviously when everybody was like, "Oh, Trump presidency,"
Right.
it was at over $10.
Yeah.
So you're getting, you're getting 90% discount on it. And then you look at the higher time frames, like, is this thing going to go down in a straight line from?
Mhm.
No, right? Like, you're going to
Right.
squeezes. Yep. Now, does it mean you'll automatically make money if you buy this? No, but your odds of making money when you buy it at $1.90 as opposed to buying it at $10 at the high, your odds of catching a 10x move are so much greater
Right.
if you wait for those discounts. And the opposite, the longer it's irrational, right? Like when the market moves in a straight line in one direction or the other, the options market's priced as if that kind of price action will
continue and be that. But that's the inefficiency of the Black-Scholes model.
Exactly.
So I totally get
Is that it's priced on
Mhm.
it's priced on the market dynamics of today, and they project it 6, 12,
Right.
et cetera, months into the future. It's priced as if things almost keep moving.
And that projection, the further out in time, I think that there's a logarithmic curve to that where there's inefficiency. I don't know exactly what the time frame is, but it's
hyper efficient in the short
right.
That's why it's a losing game to
Mhm.
play. If your whole strategy is playing zero DTEs, you're probably not
Well,
going
the
to make a whole lot of
statistics
money.
don't back you up at all.
No.
I think retail traders lose more on zero DTE than any other asset class. And now Robinhood just came out with futures. So this is more advantageous to the shorter term traders because zero DTE, I don't trade zero DTE. I don't know about you guys.
I used to, not anymore.
Yeah.
Then do it.
Futures are the way to go, in my opinion, right now. And everybody that comes into the room, and it's one of those things. I have 2 children, right? And sometimes you got to let them touch the stove to let them know it's hot. So these people will come in and start trading options.
Yeah, they'll do it.
And I'll tell you, I'm going to tell you day one, trade futures. There's a lot of avenues to teach you how to trade futures. Yes, I think traditionally a misconception is that you need a lot of money, right? You need big capital to be able to trade futures. It's not true. But the people will still come in and still trade options. And I'm like, all right, go touch the stove.
Yeah, I'm back to go figure it out.
To me was done.
Well, you'll make a few nice gains, but the thing is, you try that enough, you're playing against the house, right? Like you're going head to head against Citadel, BlackRock, like the biggest market makers in the world. This is what I always point out to you.
But if you don't mind, I really want to go back to that strategy about the inefficiency of pricing because I've already known this. I've already taught Kyle this a million times with the VIX trade. I don't know how much money you made on my VIX. I made almost 300 grand on VIX when it popped, whatever it was for COVID. I made a shit ton of money. But I did that because intuitively, I know exactly what strategy you're discussing because I know that they're not going to be sustained. So I'm actually taking the opposite bet to this. I know that they're not going to be sustained at $35 per contract. So I'm selling those to people that think that it is going to keep on pushing. So I'm actually taking the opposite trade to your strategy. However, I can play both sides.
Yeah.
Right? Like I'm doing this interview now with you guys, but I'm thinking about, if I buy 800 calls on SPY and I do that for maybe about a year out, those contracts could be quite explosive, right? The further we go lower.
And you could write the shorter dated against it and turn it into, like, you fund it by selling the shorter dated volatility, right? Collect those premiums, turn that longer dated one into a free play. And it's just, there's so many strategic ways, like the options market. That's why it's called options, right? Unlimited options. There's so many different ways to make money. And if you fall into the casino of only looking at zero D, like you're missing the purpose that it's there, like the opportunities that are present, because you're so hyper fixated on what's going to happen on the 5-second chart that you're missing out on the big gains that are there.
That is such a good point. That is probably the best point ever. You're so hyper fixated on what can happen there for the 5-second. You're trying to play like, am I right? Because I think as human beings, we are fixated on the fact that we have to be right. And I've learned actually with Kyle. Kyle is really good about this. Maybe not in the beginning when he joined HighStrike. I don't want to speak for you, Kyle.
Edit that out.
But Kyle used to be like, I got to be right most of the time. And then he, through his own study, is basically like, I don't have to be right all the time, but that risk reward needs to be, the number one thing. It's not so much about what's going to happen there on the 3-minute time frame. And most new traders think that that's what trading is. That's not what trading is. Trading is not about being right, at least in my opinion. I don't want to speak for you guys, but
yeah, I think for me, guys, I'm sure you get this question a lot too. A lot of traders come into our group and they're like, what was the aha moment? What was it for you that clicked? And I always tell them, it's not one singular moment that happens. It's not one aha moment. It's good habits that we stack on top of each other and they become our new normal. But one of those really good habits and a big step forward on those good habits is understanding risk reward. And we teach it in our alpha program. We teach it in our trading room, but You guys, when you take a step back and realize we have this risk reward chart that we can share with you guys. When you take back and realize with 1 to 2 risk reward, you only need to be right X% of the time. It's less than 50% of the time.
Yeah.
So now we go into, I love baseball, right? I'm a huge baseball fan. So we talk about who are the Hall of Famers in baseball. They get 3 hits out of every 10 guys.
Yeah, you want to be the Ikura Suzuki.
Indeed. So you need that mental connection. You don't have to be right 80% of the time, 90% of the time. You can be right 40, 50% of the time and be extremely profitable. And I've seen some of our members, right? We have some really successful members, and it's when that little block that they're stacking clicks, it seems a snowball effect, and things start rolling really, really fast for these people because you know what? So what? I got stopped out. Was my criteria met? That's the next battle that we have to fight constantly, is taking the trades when we're supposed to take the trades and not letting our brain trick us into, oh, that looks like a good trade. I should take that just does.
There's a fine line between going on tilt, right?
Yes.
And like when you're losing it, it's like, okay, I need to. If you're doing that on like the 15-second chart or something, right? And you're like, well, I lost, so the next one has to. But if you can do that, and I call this like strategic martingaling. So what I'm doing with the options, right? I'm looking at quarterly expiries. So I saw the setup, like obviously the market just continue to fall in a straight line. So I don't know if my March contracts are going to work out too well. So those ones might go bust. But is that going to scare me away from taking an opportunity in calls in the June contracts now? No, because if I look at this, right? So if I looked at the March contracts, say 3 weeks ago, right before the market totally nuked, obviously they were depressed because we had bad earnings and whatnot. So the market started to price away that upside volatility. The setup was still there for it to squeeze, right? We still had the high VIX and whatnot. So I've seen that kind of situation over and over again where you get something like the big tech earnings. They failed, they disappointed, market pulls back, and then ultimately the market just rips higher, right? So if you were to look at something out of the money calls in March at the time, they were at a good enough discount to where it was worth the risk. Now they're probably not going to work out, but the price, say you bought contracts for say 20 cents a pop on out of the money calls in March. Now those might end up worth this, but now if you look at June, right? Now the discount you're getting on June out of the money contracts, way deeper than the 20 cents you lost on March, right? So like your ability to just wait for those for the prices to come down a little bit further on the next quarterly, and then that, like we're talking about, this rubber band can only go back so far before it snaps. Then when it snaps and comes back the opposite direction, that's how you get 10, 20, 30x gains on those options.
Right. And let's unpack something there, because you've said this countless times, but maybe somebody's listening or watching didn't fully understand that. So I want to unpack a couple of things. First of all, you called it strategic martingale. Can you explain what martingale is first for us?
So when you're taking a bet, right, the more hands you're playing, the greater the odds of you hitting a winning hand, right? So exactly what we're saying right now with NQ. Can it go down in a straight line more? Yeah. But at a certain point, it has to go up, right? And the more violently it goes down, the more violently it's going to, even if it's temporary, right? I'm not saying it's just going to race back to all-time highs, but the odds of you getting some kind of wild volatility candles at the upside, which is all you need if you're playing out of the money contracts, because at that point, people rush into them, right? Like the same way everybody rushed into puts this past week. Markets credits in headlines everywhere, right? Everybody who could possibly buy it, this is what I think we're probably about to see a squeeze, is that everybody who could possibly be baited into a short position is in that short position. Now, if you look at one of the things we always look at in our morning calls is max pay charts.
Yep.
If you look at that thing now, rooted to the gills with puts on all of the indexes, it is just like and if you would have looked at it in December, and this is what's felt like, if you learn to monitor these things over time, if you would have looked at those max pain charts, say for January through March expiries back in early January, late December, it's total opposite. There's very little open put interest, but massive levels of open call interest, which was telling you the market was what did you expect? NQ to go to like 23,000 without ever slowing down?
Never a pullback. Now I want to go one step further with that point. So let's say hypothetically this quarter you're wrong. Okay, those cheap calls that you have, we don't get the snapback, we don't get the mean reversion. Now we go into next quarter. You mentioned earlier that you're going to be prepared for it by buying the June and buying moving on. What is your position sizing like on that? Do you, because these, I'll let you kind of speak. I don't want to answer your question for you, but what does your position sizing look like on this?
So the beautiful thing about these contracts is the ones that I'm looking at, they're around like basically 10 to 30 cents, right? And you have to understand the leverage inherent to options as a buyer. So every contract is getting you 100 shares or something, right? So that means if price goes $1 over your strike, you're making $100 for every move. 100-point move, that's $1,000 or $10,000. So it just gets insane, right? Like the ability to compound that leverage. So you don't need to be buying. There's no need to go out there and buy 1,000 contracts, right? You're more likely to lose if you're trying to apply that kind of aggressive positioning. But I could take, I could buy 10, 20, 30 contracts that are costing me $30 and I'm risking $1,000, right? I lose $1,000, lose $1,000. But when I'm right, I'm making 10, 20, 30.
That's what I wanted to get at. So your position sizing for every quarter, every time that you're looking at the next quarter, your position sizing the exact same. And the reason because of that is if you're wrong, it's $1,000. When you're right, and you will be right eventually, when you are right, it's 10x. And now the one quarter you missed, heck, you can miss 2, 3 quarters in a row, but the one quarter you're right made all of those losses back plus.
And what it's doing is as you lose on the one quarter leads, it's dry. So it's almost like the way I like to think of it is like I'm running a call spread, but I'm essentially short the longer one by not being long it, right? So I'm not collecting the premium on the shorter dated. I'm actually losing, right? I'm losing on that contract. But what it's doing is it's depressing the back end of that curve, and then I can buy that discount. And when the reversion comes, you get that big.
And it will come. It's undeniable that it will come.
It's something like, so we've had 35 trades that have gone over 2x since I started. We've had
200%, 2x, 200%.
We've had ones that 5 that have turned into total duds, right? So you think of that, okay, my odds of hitting a double, at least, like we've had ones that have gone 10x plus, I'm at 7x greater odds of doubling my money than I am to lose the entire investment, right? So the strategy works, but it's having that patience and
believing that it actually will, because you understand the numbers as opposed to what you think is going to happen on the charts. So the point that you made,
it's just probabilities.
The martingale system. It's the reason why I can't go to a casino and bring more than 50 grand, because I'm going to clean house, because all I have to do is just double up every single time. You have to have it as an bankroll, which
That's why the casino makes money.
There's a It's a 5,000. Believe me, I know.
We almost went to the casino last time in Oklahoma.
The casino makes they take infinite bets in, right? The casino's taking an infinite bets, but they always win because the edge is in their favor, right? So like, as somebody that's trading options, that the odds are in the house's favor. The odds are in the house's favor. They're going to get those big spikes in both directions because they want to sell that, like exactly what you're doing, right? They need to be able to sell elevated premiums on both ends. I think what we're seeing now, like obviously the VIX has been in backwardation for a couple of weeks, so we haven't seen that big nasty reversion yet, but we have seen a lot of put selling. So big players are selling puts at these levels because they're going to collect all of that out of money premium when the snapback happens and those puts expire worthless.
It's what I do. It's all day long. I'm not doing it too long dated right now because I'm very interested in what the only thing where I see that there might be an issue with this particular strategy is exactly what the X return is. If it's 2X, then there's an issue, but it's generally not that. What is that number for this actually to work? Because I'm thinking 5 quarters. If you have 4 duds, 4 quarters in a row, that means that fifth needs to be at least a 500% return. Am I thinking about this correctly?
Correct. Yeah. No, that's what I was kind of getting at was earlier. You're 100% on.
So I would like to define this. So what does that return need to be? Does it need to be 7, 10, 20x? Because the possibility for that to happen is there. Sure. You buy 50 cents on a contract for calls, perfectly fine. Can it go to $4? Absolutely. I'm looking at them right now. There's call contracts that go for $4,000, right? Depending on if they're in the money or not. But the possibility is there. So talk about that just a tiny little bit, because I might make some trading decisions after this. No, seriously. Seriously.
Yeah. So you're saying if you had 4 quarters in a row where
which is not going to happen.
It's never happened.
So that doesn't happen that way.
I might be out of business if that happens.
Right.
But it's all about side, right? So it's like, can you just throw money at it? Like if you start losing past a certain point, you have to hit your own risk measures, right? So
because I'm thinking about this, someone's going to listen to this and say, okay, so Sage and Shane are going over 4 or 5 quarters. So all I have to do is just make sure I have enough bullets in the chamber.
So the thing is, like, this is the way I looked at it. So I think in quarter 4, I cleared like over 270, right? Now I've given over 50 so that back here in quarter 1. But that's part of the game.
Right.
Like, so I look at it at that level. Like, can I kind of like just keep those risks small?
Mm-hmm.
So like I even put out that whole quarter long thesis, like saying, hey, I think the indexes are going below the 200-day in quarter 1. Did I make money on it? No, I lost money, right? That's how hard this game is you could see something coming and still be distracted, like miss your like I should have been just buying April puts in January, right? But I didn't because the market it's difficult, right? Like there was so many pullbacks there that I thought, hey, maybe this is it. But I had that I put aside a set amount of capital that I'd made in the previous quarter and said, okay, I'm okay with risking this. Here's my stash of ammo for quarter one, right? And I'm going to throw this at opportunities where I see a high likelihood of multiplying my output. Now that could happen again in quarter two, right? So I'll look at that, and if I hit a wall again in quarter two, like
this is what I'm thinking. So the lower the market goes, do you usually allocate more of that ammunition? Because I'm thinking that I don't know if you're going to get to
you
this
don't
one.
have to,
You don't have to.
because that's the beauty of this, right? The lower it goes,
The more
The next quarter.
yes, but like
exactly.
you could put that, say, like $1,000, whatever it is, $100 if you're a smaller trader, right? And when that snapback comes, it's going to be so, like, again, the leverage inherent with options, right? So I'm not going to sit there and be like, all right, well, now I'm going to do a $20,000 position, because that's how you lose all of your money.
Because I'm usually greedy the lower we go.
And when the tide turns in options, right? We saw this in quarter four. Is that okay? You ride your winner, right? You get your big gain, and then there's all of these laggards, right? So like we call it Tesla huge, right? And then it's like, okay, well, now I have a lot of money to play with, so I can parlay this into other ones that haven't moved yet, because you sense that, like, this is the best takeaway that I've gotten from options is you can sense the change in tides, right? So you can sense when the market's going risk off and risk on pretty quick. So like, I think that was basically the turning point, was that Tesla earnings back in October. And at that point, like, okay, this is popped, but all these other things are still suppressed, but we see this kind of trend changing, right? So now all of a sudden, out of the money calls and everything are starting to catch a little bit of a bid, and you can be early to that. Be like, okay, now I'm going to take some of the money I made in Tesla, throw it at this, throw it at this, and then you're just parlaying gains over and over and over. Then eventually the tape cools and you get some back, but it's like, are you ending up at a higher watermark each time? That's the goal with it.
So go ahead.
I was just going to ask, so the examples you gave were all long examples. Does this work on the short side? Is it worth the risk on the short side? Because, you know, we talk in our group, VIX, we've talked about VIX here earlier in this conversation, and somebody sitting in here watching this might not understand what the VIX is, but VIX is the measure of volatility, right? And we've had a time where we were trying to long volatility and long the VIX, and it was an absolute disaster. It's a recipe for disaster, because what happens at the stock market is VIX spikes, volatility spikes. It always comes down.
Wait, you looked at me like I gave the idea to go long VIX.
No, I voluntarily went long VIX. I think you actually told me not to, and I was like, Steve doesn't know what he's talking about. Not to do it. I did. I mean, crap, I lost my money. But to the original question is, the examples you gave were all longs. Have you successfully caught this type of a move on the short side, or do you just not even worry about that because you're planning for a doomsday in that situation?
You see, the thing, like, I don't love this, like, I'm not a perma bull or anything like that, but I recognize the discrepancy in options because of that dynamic we were talking about earlier, where institutions own a lot of shares. How do they hedge their positions? They sell out of the money calls. So you constantly have a suppressed, if you looked at the cost of an out of the money put and out of the money call, same distance away from the money, the put's always going to cost more because institutions sell the calls, right? So that creates more supply, drives down the cost of those calls, and the puts are always going to remain elevated because they're constantly buying to hedge their portfolios. So anytime you're buying puts, you're overpaying just by factor of it. There's rare instances, and the reason why I didn't catch the short is because the VIX was elevated when we were at the highs. So just statistically, buying puts when the VIX is high, there's time, like when the VIX is low, below 15, right? That's when it can make sense to look for strategic put positionings. But I mean, the damn market is designed to go, like, it just goes up. And I've seen it make like moves like this and then just retrace itself back up. So like,
Instantly, yeah.
And there's Giles said, if you're betting on it to go down quarter after quarter after quarter, you're going to much bigger problem.
And maybe this will change, right? And I'll have to shift my outlook to start doing puts and stuff like that. And I could change, like, I have no issue changing if the dynamics there change, but this is
it's not going to change
over the years, time and time again, because of that
going to change. Human nature will not change. So,
and we can get into the macro dynamics.
No. But one thing that he said that I thought was interesting is that he's not a doomsdayer, right? Because a doomsdayer is going to do this pretty methodically, right? He's going to buy $1,000 of fixed contracts and just wait it out.
I gave a lot of that money that I made during the 2020.
You gave it back.
I gave it back because I was trying to do the same thing. What I didn't realize at that time is that was once in a decade, 25-year event, right? Maybe we're about to experience another one here shortly. We'll see. But the thing, like the ability to catch that kind of a VIX spike, it's so rare. Right? It is so rare.
It happens seldom, right?
And yeah, if you're looking at this now, like, that's what you're if you're trying to buy puts right now, you're betting on a black swan scenario,
Right.
which could happen. Like this is what it would look like. We're going to happen. So I'm not saying it's impossible, but you're betting on a once in a 25-year scenario.
Right.
Are those good odds? Right.
It all goes back to probabilities, right?
It's all probabilities.
No, but it's something that he said. I don't know if you realize that you said this, but you were looking at the pricing of the option market. Do you do that more now as opposed to when you started with the strategy back in 2018?
Yeah. So
So that's the discrepancy.
that's
here.
the discrepancy. Is that unlocked? It illuminated so much
Right.
when I started to look at the historical pricing of options, right? Rather than just looking at a regular price chart, right? So you
Right,
can pull
right,
up
right,
like NQ and be like, well, I think it's going to go to $7,000 or whatever.
So that's the thing that I want to illuminate. It's not the fact that you're just looking at the chart, right? Because I believe this. I believe that not everything, not the whole thing is on the chart, but you're looking at the pricing.
You look underneath the hood. Yep.
Exactly right.
And it's like,
Exactly
this is in a value zone, right? The same way you would look at a stock and be like, is this in a value zone?
right, right.
Yes
right.
or no?
And I'm thinking just because the VIX is at 12 doesn't mean that I'm going to buy, $20,000 worth, but
Mhm.
you're looking at it. You're looking at sort of the weather that's to come because you're looking at those option prices in tandem with the VIX being as low as it is.
And what's fascinating about options too is they have gaps, just like stocks have gaps, right? And they tend to fill those gaps. So if you see a gap on an options contract that's 6 months out, right, and maybe it was trading at $2,000 contract, now it's trading at $1, and the gap's around 500. Odds are you're going to fill that gap, and if it fills that gap, you've got a $400 gain on your hands, right? 4x.
What software do you use to do?
They actually have it on TradingView now, so you could use TradingView. I like the bar charts, but TradingView has it too. If you go to
So bar chart, is it a paid program?
nope, it's absolutely free.
Cool.
So much of this data is just out there, right? It's just like knowing where to look, and I think that's what we help a lot of people with is like navigating because there's an overabundance of data there, right? You don't even need to pay for most of it.
Right. You just know you need to read the tea leaves. That's what it is.
But having somebody like that's, I think, our role is just showing people where to look, right? Like
What I like about this is that it makes actual sense rather than it being nonsensical and being something that is a little bit more. When you're a crafts person, you usually do things by feel, right? There's a lot of this when it comes to trading. There are feely traders. I'm not one of those people. For me, I like to analyze things and make sure that if there's a probability of something, which we know will happen, like 10% pullbacks. We know pulling back to the 200 EMA, SMA, those are usually where institutions are going to buy. We know that. We inherently know that. But what you're talking about is just seeing that discrepancy on a 90% discount. That totally makes sense to me. Right? I wasn't thinking about it like that. I think I always have done things that way, but
so you're looking at it the opposite where you're selling, right?
yeah,
You're looking for those moments of
course.
like irrational euphoria,
Of course,
right? So like,
of course.
and then like if you follow my options plays, I'm never like, we'll just look at Palantir, right? When that thing went to like 130,
Right.
there would never be a time in the world where a stock's up whatever that was up 5x in 3 months where I'm like, hey, this is a good time to buy gold.
Right.
Terrible risk reward.
And there was people, and I don't know if you guys experienced this, but there were people actually asking me if I was going to buy Palantir at 121.
Yeah.
I said, you're out of your mind, homeboy.
What exactly you're talking about is that is the key of trading is zigging when everybody else zags, right?
Right.
So like everybody when they start trading, they see what's moving and they want to trade what's moving, right?
Right.
And that it's not to say it can't persist. Like things can get irrational in both directions and just go up in a straight line. But are you going to hold on? One, are you going to hold on to those gains, or are you going to like your odds of buying the top
Right.
are extremely high? And I think when most people come in, the reaction of the monkey brain is to want to buy what's ever moving fastest,
Or
right?
to become part of it, right?
Yeah.
Because you already see it up there. And I'm usually, I say this all the time. Usually when everyone wants to be in is the time that you should be as far away from. Yeah, it's the worst possible time.
When your Uncle Talks asks you about a ticker at Thanksgiving dinner, you go short.
But taking it a step further than that, just looking at the chart, any chart, all those charts, especially when it's parabolic like that, you generally see almost an equal pullback ratio. We use fibs. I use fibs extensively. So you
Can't sustain.
it never is going to sustain. I had one guy, I don't want to say his name because I don't want to point him out, but he bought Palantir. I think it was at $22. And I told him to hold on to it. And then he sold it for 108. So I was like, okay, that's fine. And then he said, do you think it's going to go higher? I said, if it does, you're already at this massive gain. Why hold on to it? Why be overly greedy?
Right.
So that's what, and
Because there's better opportunities out there, right?
of course,
The next Palantir.
Yes.
exactly right.
And once you find those patterns, right, like you can find, that's basically the crux of my approach is finding what nobody else wants.
Right.
And if they're going to give you the upside on it while it's in that kind of stealth mode,
Exactly right.
take it with some time, and then you just let the kind of dynamics play out.
I agree.
And that's how you can get, like, you find something that has that kind of potential. You see that set up enough. Like, look at the Palantir chart. What did it look like for the past 3-5 years, right? It was just in a long period of boredom. It was kind of a retail momentum trade back in 2021, right? When it IPO'd, everybody was like, oh, it was going straight to $100. Didn't, fell flat. But what happened during that big low period, while it was just kind of hanging around, what was it, like $5 to $20 for a long period of time? All that time, that's how institutions get positions, right? Is they're not going there and they're not pressing buy on $1 billion position at one price. They steadily average in.
That average, right? So
Just swapping in. Right?
that's why when you look at the option chain, you usually see orders $7-8 million, and they're stacked on one another.
And what are they doing that whole time? They're selling the crap out of calls, right? So they're making that position pay for itself. Then when they're done filling their positions, what you'll see is, like, then all of a sudden they'll start buying out of the money calls, right? They'll buy up tons of gamma, and then they start pressing market buy and send it. Like, it's all a level of manipulation, but if you know how to see those signs of manipulation, you can let it work in your favor.
Let me ask you this: Palantir overvalued. We can all agree there, right?
Yeah.
It's subvalued. Does that take part in any of your calculation when you're looking to either buy into something or not? Because I'm going to tell you this: I bought on. I bought it at $30, and then I sold it for, I think I sold it for 52. I bought Adobe when it was $73. I'm talking years ago, before you guys even were trading. I bought this years and years ago. I held on, but I held on because the valuation always made sense to me, right? It wasn't overpriced, specifically on the fundamental analysis aspect of it. Is that part of your calculation when you're looking at specific trades like Palantir? I think it's the most recent example, so it's relevant.
I think you need a measure of both, right? Like, very rarely does anything trade at, like, markets are just inherently irrational at all times.
Right.
So nothing is ever trading at perfect valuation.
That there's fundamental people and boomers that I know that say this is at 15 times valuation, so I'm not going to trade it. And I said, you're out of your mind.
You're going to miss out when it goes to 50x.
Exactly.
The market's going to remain irrational.
I've made peace with that, because if you're looking at markets outside the US, there are things that are fairly valued. There's nothing in the United States that is fairly valued. I don't see it, right? I definitely don't see it. People constantly talking about some institutions that are buying in, even they realize that. There's no such thing as fair valuation any longer, unless it's an IPO.
Right. And who gets to pick whether it's fair valuation or not? There's nobody, no singular person or entity that gets to pick whether it's fair. That's the beauty of the stock market and all the individuals and the people that get involved into it. Is it's a speculation hot. Yeah. It's a melting pot of people's opinions. Casino. Yeah. So, I mean, that was a really good look into that was a really good look into Shane's trading style and kind of what he brings to our community and what he brings. And you got a little glimpse into what Sage does, but I kind of want to shift the focus over to you, Sage, because you do something unique as well. And you guys have both touched on it, right? You're buying on the discount and you're looking for that overextended, the moves happen. People are super excited, joining the train late. I'm going to short it and I'm going to go the opposite direction, I should say. And talk a little bit about how you're doing that and what is it that you're doing that's so unique? Because I don't know that there's another trader in our little small Discord trading signals room industry that does what you do.
I like to look at hyper priced options, and I've done this because this is my trade and this is how I learn. Everything that is overpriced, I understand that cannot be sustained. So that unsustainability for any pricing on the options, exact opposite of what you were saying. I'm looking at the other dynamic of that. So I am for overzealous traders. If you're looking to buy calls on Palantir at 121, I'm going to sell them to you.
Can you explain in layman's terms what do you mean when you say you're going to sell it to them? What does that look like?
So with selling options, traditionally, it's very expensive to do if you do it at a naked capacity. So what that means is if you're going to sell just a naked call, what is it? The risk reward to that is pretty terrible. Generally, people who are selling, they usually do it for banks, right? They sell calls against their bank stocks and they try to collect premium on that. I figured out 15 years ago, that if you do spreads, then the risk reward is actually a little bit better. As of late, I've been doing in the money credit spreads. And I found, actually learning with you guys, this is a little bit of fundamental change with me. If I'm a little bit more disciplinarian on the risk reward side, it actually benefits me more. So what you're saying, and actually how you trade as well, focusing more on that 2-to-1, 3-to-1, or in Shane's case, 5,000-to-1, it can benefit me more, specifically on SPX because they're European style options. So I'm thinking about it like that. And I'm thinking, as Shane was talking, and you're going to have your turn here as well. I'm thinking about doing those in the money trading positions. And usually the backlash that I get is you're going to be exercised on the position. You have the option to exercise the other leg if you're doing 2 legs. So, okay. For smaller traders, this is not it. I am not your person. For smaller traders, it's Kyle. For smaller traders, it's what Nate is following with the bots that you guys don't want to share with me with.
So you're doing the institute, you're writing the options.
But the reason why I can do that is because I do have a larger account.
Mhm.
But not necessarily to say that, because the way that I manage my account is inefficient. I think so with capital, because I have to use a lot of capital in order to make, 50, 60, 70% ROI. Is that going to work for everyone that's trading with less than 100,000?
Is it a way? Yeah, it's not a way to grow a small account, but when you have the money,
Exactly.
it's another level.
I think about it like this: $1 million account, right? When we all get there, $1 million account, I don't have to work that hard in order for me to make $100,000 a year, and I don't have to pay anyone to do that. I'm down multiple 6 figures this year, but I'm not fretting it because I know how I'm going to.
Happened before. Yes, it's part of the cost of emission is pullbacks, right?
The only thing that I'm finding out now, which is fascinating to me because I'm learning through you guys as well, is the fact that I don't have to adhere to a lower risk reward profile if I can do it in a different light. And I can do that with options, selling them as well, specifically with options that you can't exercise I'm thinking specifically with SPX.
Yep.
But my thing has always been, and this is my training, this is not going to change because this is how I built my wealth, trading iron condors in extremely wide capacities. So I'm going to do that. My iron condor.
So you love doing that into earnings, right?
Yeah.
So as everybody's placing their bets into earnings, right? Everybody's lined up at the casino.
Right.
You're the person taking the opposite side of it. And like, here's your ticket. Here's your ticket.
Here's the window that it has to be within, and I make
what I've learned is that not everyone has the training or the mental capacity to, because it's exhausting. It really is exhausting. And some people, you cannot suffer a $25,000 drawdown. I mean, for people listening, they're going to be like, 25 grand is just too much money for me. So that's where I want to defer, because I actually think that your strategy and your strategy are far superior to mine because the math makes sense. Right.
It's a measure of like, how active do you want to be? Right. Like
that is very true.
That's a big
that is
part
very
of it.
True.
Is that like, if you don't want any draw, like you want as small drawdowns as possible, right? Trade futures, and you just turn yourself into a surgical futures trader.
Right.
You'll never have to deal with any drawdowns, right?
Yep.
But if you want to make 10,000% gains, like, I'm sorry to break it to you, you're going to have to deal with some drawdowns from time to time.
And you're going to have to wait.
Yes.
That's the thing that most traders don't realize about trading. They want to show up to the trading floor and learn
$100,000.
Right.
They get the itch, like, I got to take a trade today.
But right now, it's like, man, it could. And that's the part of it, is you show up, you execute your strategy and your process. And this is what I found is like, yeah, those 100,000 days come, but it doesn't come by randomness. It comes because you show up and you do the same thing every single day.
I think that's a distinct key between a profitable person and an unprofitable person, is you had your system and then you are disciplined enough to wait for your system to play out.
Exactly.
The unprofitable person is like, okay, cool, my system's not ready yet, but I'm sitting in front of my computer. I need to do something. Like, might as well take this trade and see if I can make some money.
Yep.
Well, no, your system's not ready yet, and you're jumping the.
That's the hardest part, is people will overposition themselves at first, and then when it doesn't work right away, give up at the least opportune time.
Exactly right. I'm so glad you brought that up. It's strategy hopping. How many times have we seen a Discord or trading room member come in and strategy hop? Like, one second they want to be a trend trader with me in the EMAs, and then the next second they want to go sell options with Sage. And Shane's new here. He's swing trading. I'm a swing trader now. It's like, it's not always going to be sunshine and rainbows. It's just not. There's going to be down. Like, this past week was one of the harder weeks for me that I can remember in quite some time. But guess what I'm not going to do? I'm not going to get away from my EMAs. And I'm not going to get away from trend trading.
And I'm doing it.
And I'm not going to, because I know what has been working for me for the past 3 years. And I know that I'm going to get it on the right side.
Yeah. Like, we track all of our trades, right? So like, we can look at data and we can say, okay, it's almost a situation where the more you lose, the more likely it is to, right? So the time you feel like tapping out, that's actually the best time. And this is what I couldn't stress that enough in like December of last year. I was like, man, like, I forget what it was, something like 20 trades in a row. There was a bunch of, and I couldn't lose. I was like, man, you couldn't lose. Just full transparency, like, this can't sustain. Like, it's not.
Well, hot hand fallacy.
Yeah.
And I remember you were cautioning people because everybody saw your trades going for 100, 200, 500x. And we were like,
It happened.
do not oversize on the next one.
Yeah, that's the worst thing.
I say it with my stop outs in the morning. You know, a stop out used to emotionally affect me. The heart rate would go up. You get that little tingly feeling in your throat. You're like, oh, this is affecting me. But now I've taken this shift in mindset, and granted, some of it has come with more experience and more trades. Like I've seen a lot more. But I'm one step after I get a stop out, I'm one step closer to my next win. That's where my mindset has shifted to, where, okay, I mean, maybe my strategy was wrong. I'm right 60% of the time. So 6 out of 10, I'm going to be right. That might've been one of my 4, but I'm one step closer to the next one in that bunch of 6 that I'm going to be right. And my job is not to doubt it or question it. My job is just wait for the next time that it comes
to the path. Stick to the path, right?
Absolutely.
All right, so we were discussing different strategies and how we're looking at different time frames, and we are applying different methodologies in terms of forms of thinking for trading. Now, that sounds really superficial to someone that's probably doing this at a lower level. What do I mean by that? Newer traders constantly want to come in, they want to turn $10 into $10,000. Cool. It is possible, right? What do we advocate for here at HighStrike? What do we generally say your focus needs to be? What do you guys say?
Risk reward, risk management. R multiple is what we call it in HighStrike.
Okay. Is that the most important thing in trading?
Most important? No. I'd say it's one of them, but it's not by itself. With proper risk management, you still don't have a winning strategy. You need other elements to be combined with R multiple,
okay,
to get the success that you're looking for.
Okay, so what is trading? Like, what actually is trading? It's about making as much money as possible, right?
Yeah.
Okay. Trading is a problem, right? So to come to a solution to that problem, how do you reconcile the two things? How do you actually find a solution to the problem that you have of trying to know where the market is going to go at any given moment?
Yeah. So for me, I would probably consider some sort of a back-tested, proven, profitable strategy, right? So you have certain criteria that you take before any other trade is even considered to be taking. So that can be really anything. I do think that there is such thing as analysis paralysis, where if you have too much information going into a trade, you'll always find a reason not to take the trade. So you have to, and that comes with some trial and errors, right? You have to test it out and figure out what's going on. But for me, I got 3 boxes, right? My EMA stack, my squeeze, and my levels. If I have 3 of those things lined up, all my boxes are checked, it's time to take a trade. Now, next step, right? That's one of the boxes that has to be, that's one step in this. The next step is, does the R multiple make sense, right? Risk reward, we call it R multiple at HighStrike. Am I getting at least my 1 to 1.5, 1 to 2 risk reward for my trade? If the answer is yes, then another box check, time to start moving forward. And then third, and probably equally as important in all of these, comes down to position sizing. Okay, how are you managing your capital, right? There's strategies that go behind it. And so I pride myself on being very robotic, very disciplined in what I do. Mine's 3 micros trades. If I get myself in trouble, it's because my position sizing's off. And why is position sizing so important for me? It's because when we have such a robotic trading strategy, we want the data. We want the back test. We want the proven information that we've had. And if I have one trade that's 3 micros, 9 contracts versus 3, and that's a stop out, well, guess what? My winning 3 micros is now my stats are all off. My data is no longer accurate. So that's why it's super important to me that we're very disciplined in our position sizing. We're very disciplined in our entries, or all our boxes checked. And then, do we have the right risk reward management?
Okay, so that's trading. That's what trading is to Kyle. Shane, I'm going to bring it over to you. We know what trading is on the macro, but what is trading to an individual? Because it's going to be very different to each human being. Like, trading to me is different than it is to Nate, than it is to Kyle. Ultimately, the outcome is always the same, right? We're looking for the same outcome. I want to make $1 million and I want to make it tomorrow, right? But how do we get to that thing? I look at it like it's a problem that you need to solve. So how do you solve that problem for yourself?
It's about finding relative value, right? So the whole game of trading is buying something today and selling it for more money tomorrow, or selling something today and buying it back cheaper tomorrow if you're shorting it, right? So it's a matter of putting those puzzle pieces together and finding your own alpha, like figuring out how to, it's essentially a giant jigsaw puzzle, the entire market, right? And given the way it swings, the fluctuations and whatnot, there's infinite opportunities to be found in a single day. Any single day, you can find a million opportunities, but it's narrowing it down to the ones that have the greatest risk reward probability and the greatest opportunity to pay off. Now, if you're doing that from a futures perspective, like Kyle, right, you're looking at those miniature swings on 4-minute charts. So there's opportunities in the 4-minute chart. You can look at the higher, like what I'm doing with the options. A lot of time I'm looking at daily, weekly, higher time frame type setups. and I'm looking to catch those big moves in volatility, right? Because exactly what we were saying earlier, the market doesn't properly price those longer dated options. So if you get a high read on something on a daily or weekly chart, you're like, hey, this is going to reverse in the course. I don't know if it's going to happen tomorrow, but I know statistically over the course of the next month, this contract that I buy that's 3 months dated, sooner or later they're going to have to pay me out. They can only keep this thing suppressed or elevated for so long before we get that kind of reversion, right? So if you see something at low levels of RSI and every indicator is pointing to you of bottom, right? The odds of you going out 12 months and buying a contract, it's going to be pretty cheap volatility if it's out of the money, right? Because the market's priced for it to remain in that stagnant, depressed, or elevated state forever. And then you can capture those reversion squeezes in one way or the other. And that's how you get those big payouts on the higher time frame stuff.
Okay, so we basically talk strategy. I want to actually hear from Nate, because Nate is the person seeing this from outside the lens. Like I can rationalize my trading strategy to myself, but I know that I make sense to myself. Everyone watching is like, okay, these guys trade.
It works for you. How does that apply for
How does this work for me? How do I make this into something that is actionable and something that has monetary value to me, right? Because that's what the audience cares about. Like if I was on the other side of the camera, I'd be like, okay, this is great, but I don't give a shit if it's not applicable to me.
It has to be your own art form. And so everything that I do in trading is a summation of a bunch of different parts that I took from here and there and made it my own, right? Like there's nothing, I didn't take somebody else's style and say, hey, look, I'm just going to copy trade every trade that this person takes.
Be you. Yeah, it doesn't.
It won't work. It has to speak to you, right? Like it's a personal expression.
Right.
And like we were talking about, like I've seen so many tail events in my life in markets where market moves in wild directions in both swings of that pendulum, right? When it goes from extreme to extreme. And I've seen those events where those crazy bets pay out. And when they do pay out, they pay out in insane. And I like to capture that tail risk, right? Like that's just the way I'm wired. I love that game. You like the opposite. You like to sell the extremes, right? So rather than trying to bet on an extreme outcome, you're waiting for the extreme outcome and then you're selling it to the people that expect things to remain at
or to revert to the mean, which is basically how I explain my strategy to people that identify with the terminology that we use. Because sometimes we're talking about certain things, and I notice with newer traders, they're not even acclimated to the terminology. They don't know what reverting to the mean means. Like when Kyle started with me, right? Kyle started with me, learned how to trade a little bit, but then he went off his own gamut. Just what you said.
It's all about your mentality, right? Like,
right. And he was exposed to certain things that he didn't have before, but now he has his own trading strategy. It would be incumbent upon every trader to look at it as your own responsibility. Like think about it like you're a craftsperson. Are you going to copy and make this table the same way that your mentor taught you? Yeah, probably for a little while, but then you're going to venture off into your own thing.
You're going to take a piece from here, a piece from there, right? And
we kind of pulled the limelight here from Nate here. Nate's like patiently waiting, but of course, we want to hear your opinion on this because you are a representative of the people that actually want to learn how to. I put in my 10 years. I put in my 10,000 hours, right? And it has benefited me. Kyle, I think you're almost there.
Halfway there, yeah.
Okay, halfway there. And Shane, I'm pretty sure that you're there as well. I put in my time. I put in my time like no one will believe. But from someone looking at this, with the glass half full, that is still thinking, all right, I'm kind of understanding what these guys are saying to me, but if you don't mind, just expand on the different trading strategies that we talked about thus far, but how it is that you see it. You're not a newer trader anymore, but when you first started trading, how is it that you saw it? And when you were listening to guys like us, like how did you go from complete novice to actually starting to understand what we're trying to say what trading is about?
Yeah, I think at the beginning, it's a lot about just consuming as much as you possibly can, right? You don't know anything, so you don't know what you don't know, right? So the only way to figure out what you don't know is to see what other people are talking about. So for me, that looked like joining communities, joining chat rooms, just kind of throwing myself into the fire and seeing what other people are doing.
Exposure.
Exactly. So watching other traders talk, watch how they, trade, watch how they read price action, watch how they find their levels, all of those sorts of things. And just like you mentioned, Shane, I'm not necessarily copying one person and saying, hey, I'm doing exactly what Shane is doing. I'm taking little pieces from everybody else, and these little pieces make sense on their own. And then I kind of have to put these pieces together and come up with my own strategy, right? And the reason that's so important, I think, is because we are all fundamentally different human beings, right? What works for Sage what works for you, Shane, what works for Kyle, what works for me. It's all different because we all have different places we're at in life. We have different goals. We have different psychology. We have different account sizes. We have different mentalities, all these different things, and they play a huge role in how we shape our trading career. So for me at the beginning, again, it was just consuming as much as I possibly could, seeing
One size fits all approach to trading, right? Like
exactly.
it does not exist. And a lot of people, there's a lot of money to be made telling you that it does exist.
Right.
So that is not what we're doing.
Absolutely.
Our goal as coaches, right, is that we've absorbed all this information, like everything I was saying. Like I've read countless books, spent countless hours in the market, lost countless dollars in the market, made tons of money in the market. And what I can do is essentially sum up my experiences and distill it in a way that can hopefully help you and make sense of a lot of things. Right?
Exactly.
So it's like putting all of those things together and showing you the approach that I use that I found to be repeatable for success, and showing you how I do it, right? And then so you can take that information and you can piece it together with other information you get from elsewhere and learn how to do this in a repeatable way, sustainable way, and ultimately build yourself into your own trading style. It's going to be parts of what I teach you, part of what Kyle teaches you, parts of what Sage teaches you. But you can take all of that information and essentially, instead of having to put in 10,000 hours to learn all this and touch the stove and learn the hard way, we hope to cut that down to maybe 100 hours, right? Where it's going to save you a whole lot of time and error of having to go about this on your own. And we're going to show you shortcuts, right? Doesn't mean it's going to be easy and overnight, but we're going to help expedite that process.
Yeah. I mean, it's all about streamlining that process, like you said, right? The first, I think we talk about this pretty often. If you're trying to learn on your, probably going to take you 2 to 3 years, you're going to lose a lot of money and make a lot of
costs.
Most people are going to quit.
Most people quit after the first ounce of pain, right? Like that's just the nature of it.
That's human nature, to quit at your first pain point. I remember when I studied Kung Fu a while back, we would do really extensive stretching exercises, and people couldn't really fathom the pain, and that's where people would generally quit. Martial arts very much is like that. Trading is the same thing. You said something interesting, but like my trading style is not for everyone, but I stuck with it. You see what I'm saying?
Stick with it.
I stuck with it, and I was determined to understand how I make $1 and just replicate that 1,000,000 times over. It's the same thing with you guys. Like you have your own, and this is what I think is admirable about what we do, is that us as coaches, I think that all of us do this, that we're not necessarily trying to create copies of us, right? I always recommend, like, if someone's going to learn my style, then they should go to Kyle if they just want to learn a different style and just have exposure to it. But it's more about unlocking what works for you in the long term. I think that that is something that I didn't realize when I first became a coach, but now I'm starting to come to that realization a little bit as I'm progressing with this, because we learn as well, and we're learning because we're dealing with other human beings. But it's very much to that. It's not about you selling options or doing the 3-minute time frame or doing your strategy. But if you identify with that, then that person can recognize that and make sure that that jigsaw puzzle in their head makes sense for them, because you need to understand how to make money first. That's what trading is for me. Trading is not just about me showing up to the chart and then reading the 4-minute or the 4-hour time frame and then making a decision off that and making a bunch of money. If I get it wrong, what am I going to do about it? And then go from there. You see what I'm saying?
That's the journaling process. I think what a lot of people don't realize until they get into a group like ours is the cost of entry right now. The barrier of entry into trading is something like I don't think's ever existed, right?
It's
as low as it's ever been, right? And there's different brokers out there. Like when I started, I was losing my own capital. Like I was putting my real money on the line. I was losing my
That's
real
all you've ever done.
And so now, but like with these prop firms and with these different things that are out there, there's ways to learn this at a fraction of the cost as what we probably invest.
I was never really exposed into it until I actually started work with you guys. Like I've heard of prop firms before. I've actually never traded them myself yet. Probably will start this year. But like it was something I looked past, and I've just learned this by using my own capital. So the hardest way imaginable.
I'm the same way.
But
like I can see the advantage of prop trading, but like for me at this level, there's no necessity for it.
Yeah,
I have the capital for it, but
not to mention props don't allow what you do when it comes to the credit selling. It's strictly on the buy side for what I'm teaching, and even on the swing trading a little bit. There's some that allow swings. Like you found one that the swing crypto.
There are ones out there, but it's so for somebody that wants to get into trading, you're terrified of losing your own money.
Right.
You have a fixed risk to get into prop. Was it $150 or something?
Depends on the account size, but yeah, roughly $150.
I was a whole lot more than $150 when I was bringing
learning.
Use other people's money to learn how to, like, it is the highest reward, lowest risk type proposition out there. You get like that. I think that's kind of the beauty of our channels is three-pronged approach, right? So if you've never traded before ever in your life, the easiest way to get started is to do the prop firm stuff, right? You learn the futures, your basic 4-minute charts, right? You're just trading off what's right in front of you, that price action. You learn how to do that, and then you get into the more advanced stuff as you have a little bit more capital to play with, right? So after you kind of build yourself a buffer, then it's like, okay, now I can take a little bit more risk, start doing swing trades, options trades, etc. There's kind of a natural progression that we put people through in the room, which I think I haven't seen in any other group where they do this kind of comprehensive stuff, right? So we cover everything from what's going on the 4-minute chart to what's going on in macro and crypto and how to sell options, how to buy options. It is all there, right? Like it's almost an overwhelming amount of resources, but if you put in the time to really apply yourself to what's the word I'm looking for? The education we put out there, right? The curriculum. It's all there for you, right? You just have to apply yourself to it.
How does that progression look like for someone that start? Because we were talking about this, we deferred a little bit back to it, but that progression for someone starting off, because most of the people watching are going to be like, okay, I want to start investing, but I get this question asked, and it kind of feels weird to me. It's kind of like asking me, like, what is this? This is coffee. Like, I understand this, right? To my core. I understand the vocabulary there. You asked me about mean reversion. I know what that is. But for some people, they don't know what that is. And generally, I don't know if you guys have found this, but newer traders are starting out with scalping. Scalping is the most difficult form of trading, in my opinion. It's extremely predatory. And this what you were talking about with the prop trading firms. They don't allow different styles of trading, at least the ones that I find to be more successful. Swing trading, you can be very successful with trading. Selling options is the same thing. But with the shorter time frames, how are they making their money? I don't even know if I can say this on this interview, but how are they generally making money? They're making by high turnover.
Failed accounts, right?
Well, so failed accounts. Cool. So when people are generally starting to trade, they come at this at a capacity of buying 0DT options and generally scalping. What do you think, or what do you guys recommend, just by your own experiences, what would be the natural progression for you to actually build a foundation for you to be a successful trader going forward?
Yeah, I think this kind of happened organically in our group, but I've been saying it now for probably a couple months. What I teach in the chat futures corner in my little section, I would say is kind of like the undergraduate work that you put into in college. And then as you get your strategy, especially if you're learning what I'm learning with the bag indicator and the different things, the EMAs and the trends, it doesn't change when you go up to the higher time frame. So you get your undergraduate with me, you learn the lingo, the terminology, you learn all that stuff. And then you graduate up into what I would say Shane's corner, where you're doing some swing tradings, but the terminology you're using is the same. It's the same. And now you're getting your master's degree from Shane's corner, and you start to go get your doctorate from Sage. And from Sage's perspective on selling options, that's really not account growth. That's account management, right? You're preserving your account at that point because it's large enough. With me, you're trying to grow your account. You're definitely trying to make money. You're trying to get it larger. Same on your front. You're doing it a different way with the swing trading, but the terminology, you'll have the really good base knowledge so you can build up into there. And I don't think there was any intention behind it that I'm aware of our group, but it kind of happened organically. And it just makes so much sense to me when I can just see the brand new newbie traders come in, ask some of those silly questions. I always say there's no stupid question, but ask some of those ridiculous questions that you just don't know the answer to. I will help you. We'll teach you that. We'll pass you on to Shane. You can start learning these swing trades. And then finally you graduate with Sage on them.
Well, to Sage's point earlier, like somebody comes into this, right? You look at markets, it's like somebody walking into a casino, right? And the natural impulse of people, they're going to the slot machines.
Right.
They're going to the roulette wheel. The places where the odds are most stacked against you, right? So our kind of goal with this is to teach people how to play poker, right? So games where you can have a bit of an edge over the house. But it comes with a lot of focus, right? You have to study and prepare. Like you don't become a great poker player overnight. You have to learn the strategy behind it.
And most people don't want that. Most people think that trading, because we abstract everything in life, everything now in this day and age. I remember when the internet was coming up. I had a compact Presario 5000 version back in 1998. So I still remember that stuff. And I remember like technology was nowhere. Now you can pay $50 to get institutional orders on your laptop, right? We didn't have that 10 years ago. I don't think we even had that 8 years ago. So just the advancement of information that we have at our fingertips is overload. And now we have more information, lower barrier to entry, and everyone is jumping on to 0DT options because it's fairly simple to understand. It is simple. It's very binary. It's either up or down. I can tell when a trader is very inexperienced when they ask me, what do you think the market's going to do next? You think I have a clue? I have no clue. I spend 8 hours a day on my chart sometimes. because now I'm doing this full time. I have no clue what the market's going to do. You're asking the wrong question. I know when someone has experience when we're talking more in terms of probabilities or more in terms of setups.
Probabilities.
Yeah.
It's all probability.
And then I think that I'm saying, you're tied to the notion that if I'm right or if I'm wrong, there's value to that. There is, but there's more value to understanding what the risk probability is, as opposed to, are we going up or down? Up or down is very binary and very simple, right? You can't abstract that from trading. If you are an actual trader and been trading for any period of time, you understand what I'm saying. Not just you guys, but you guys watching along with me. It's not just about being right or wrong. And some of us, we accumulate that where you're wrong 3 times in a row and all of a sudden you're no longer a viable human being, right? We get that a lot. People take drastic measures sometimes when they're on a losing streak. We see it in the crypto space all the time. People lose their money and all of a sudden they want to unalive themselves, right? So it's serious. It's a serious business. So when we're talking about that,
and attach yourself to the outcomes of trading, right?
that's what happens 90% of the time, right?
If you're attached to it, you're using too much size.
Right.
So the question isn't, right? So you said the question isn't what's going to happen next in the market. The question is, if X happens in the market, what are we doing Y, Z?
Mm-hmm. Right. So this is what I was alluding to. The way that you guys trade, the way that I see you guys trade, and just understanding how you trade your systems, you're very much you're tied a little sometimes emotionally to your positions, but not as much as someone that is more novice to this. For you, you play probabilities probably better than any trader that I know thus far. And Shane is basically the same way, but you're doing this at a larger scale with larger time frames, right? So let's talk about that. Let's talk about just shifting a little bit of the mentality to where we think people actually need to think about trading and show up to work every day, right? Because most of you want to be full-time traders, kind of like us, right? You guys are full-time traders. All of us are full-time traders. But how do we get to that? Because you slip up for 1 or 2 days and that starts to accumulate, right? I don't know if y'all ever felt that, but sometimes I feel that. I feel like, damn, I have a 3, 4, or 5 day losing streak, and now all of a sudden,
everybody hates it. You go from being a rock star to being the worst person in the organization lately.
And now you're starting to think, how am I going to pay my rent? Or how am I going to pay my bills? This is the only capital that I have, right? There's a whole bunch of other things that we can discuss. But
well, that's the scary part about becoming a full-time trader. When you walk out on that wire, and you're fully dependent on that. It's a different level of risk, right?
It is.
It's a serious commitment. So I always tell people, I started doing it in 2018. It became like my full-time income, and it's scary, man. When you first start doing it, your risk appetite shrinks. You know what I mean? You think it's easy to panic a lot of times. But if you have your system, you stick to your system.
And you stick to it. That's what I was saying before. You need to understand how to make money. Traders get it twisted where they think the amount of time that they spend on the chart should equate to how much money they should be making.
It's the only job in the world where the time doesn't measure.
You're not paid for how much time you invest. You are paid for your cleverness. So if you are clever for 10 seconds every day, you can make $1 million.
Yep.
You are not paid for how much time you have invested in trading overall. Who cares that you put in 15,000 hours? It doesn't matter. What matters is the statistics and your journaling. That is the only thing that matters. And how well your win rate is not even that important. It really isn't. You can have a 5% win rate. Some of the best traders in the world have a 20% win rate.
It only matters how right you are when you're right.
Exactly. What is the size of the win relative to the size of the loss? That is the only thing that matters in trading. Everything else, moving averages, Bollinger Bands, Keltner channels, all this, it's all fluff compared to that. That's what trading is to me. Cool. So there it is. I define that.
A good example of what you were talking about before too, like a novice trader comes into this, right? What's the instinct? 0 DTs, and I'm going to buy options ahead of a binary event like earnings, right? So like a good way to break that down, how would you trade earnings? Say, let's just pick a random stock. Say NVIDIA comes charging into earnings. It's up 50% in the past month. IV's through the roof. How are you going to structure that trade?
Okay, so that's a really good segue into my trading strategy. I look at pricing for options constantly. It is literally the thing that I do. Whenever I'm looking at the chart now. So whenever I'm looking at something like this, I always look at relative earnings, usually about 3 or 4 quarters back. So then I'm looking at what is the option market pricing in terms of a move. And then I'm looking at just the buildup into that zone. If the implied volatility, generally what I say is 2 times forward looking, then I'm usually putting on a neutral trade. I have been massively successful with this.
Just to explain that, the implied volatility is essentially a bunch of people are placing bets in both directions, right?
Yep.
And the options market's telling you that there's a large expected move. So heading into a binary event like earnings, the options market saying we think it's going to go 10% up or down. But you can see historically, hey, it's only moved 3%.
That's exactly right.
Right. So this thing's overpriced. Right? And that's telling you that it's time to step in, and you can explain how you might.
So what is the observation that I've made over the years? The observation is that the general expectation in the market usually falters through. We don't hit expectations.
It's all priced in. Right?
It's usually that's what it is. Because what is the next earnings event on NVIDIA? That they are going to obliterate earnings, and then they're going to continue a 100% year-over-year growth. It's not sustainable, and I understand that. And it's not just NVIDIA. I do this on a multitude of different stocks. But the ones where I see that they're outpriced, then I'm usually doing a neutral trade. And it's not difficult. It's an iron condor, usually with a nice little wingspan, and then I try to catch that contraction that usually happens for earnings. About 70-75% of the time, earnings contractions happen on pretty much the larger stocks that we have in the market. Mm-hmm. I've been able to capitalize that for now about 12 years. I've been doing that for 12 years.
And in that situation, explain, how do you make money? Because now you're saying a neutral position, right? The iron condor. So you're setting this window right here, and how do you make money in that window? What needs to happen?
The newer traders, what they're going to do, I'm just going to look at my chart here just for a second so I can give you some numbers. If I'm going to go into something like NVIDIA, I'm going to look at what the price is for the call contract, which usually the new traders are going to go for the out-of-the-money call or the out-of-the-money put, and they're going to pay a relatively cheap amount for that particular contract. I understand why they're doing that. So this is very much understanding your opponent, right? And I truly believe this in trading. I understand what my opponent, retail traders or dumb traders, I don't like to use that terminology, but
it's the poker analogy, right? You got card sharks and you got the people that are there to get fleeced.
So I understand the novice person, how they're thinking about what they want to actually happen in the market. Are they going to win or beat me out every once in a while? It's going to happen. It's going to happen about 20% of the time, but 70% of the time I'm going to be properly allocated and I'm going to collect that premium. So the people that are buying the out of the money calls, out of the money puts that are overly exaggerated, I'm going to buy some protection. And then I'm going to go from there. I'm going to look at my risk reward, look at my ROI, and then just go from there. Do I need a lot of capital to do that? Yes and no. If I want to go at large magnitudes, am I going to put $50,000 behind an earnings trade? I've done it. I've done it many times. I'm going to put that on. If I like the numbers, I can collect maybe 27 grand off of that and call it a day. How often do I win on those? About 60, maybe 70% of the time. That's what my statistics say.
So, and winning is those contracts expired. Yeah. Through expiration. That's what winning is.
The buyer wants...
Well, just to have that huge IV crush that happens after earnings, right?
Like it always happens. Even with a large move, a substantial move, there is always volatility contraction. What you're losing out on is the intrinsic value of that appreciating. So all that extrinsic value is now no longer in the contract, but that intrinsic value, if I'm wrong or if I exceeded the threshold on the put or the call, that's where I get screwed over. But it's generally not going to happen if I have the correct parameters when I take the position. Does that make sense?
Cool. Great example of that. So back in July of last year, I'm looking at the Tesla chart now, looking at the summer of 2024. So between June and July, ahead of the July earnings, Tesla ran up from about 179 all the way up to 283 right before the earnings. So the earnings didn't even come out yet, but you could tell the market was getting overheated. So any kind of bullish announcement like Tesla could have beat earnings by 1,000%, odds are it's priced in. Right? So if you were looking at that, retail traders going into it, they're like, oh, it's going to beat earnings. Look how much it's up, right? Like,
more tweet.
The market must know something. The market did know something, but it's priced in.
Yes, definitely did know something. And you know what's interesting? That now that you bring it up, you were going over that. I caught Tesla before you caught Tesla. You bought in at 250. I bought in at 185. I made a crap ton of money on Tesla last year. So I bought in a little bit earlier just because I was going through my fundamentals and my technicals. But you caught wind of something, which is that the option market not only was pricing in those calls, but you actually saw that volume there, right?
Well, there was two things. So there was that. This is July of last year, right? So then the earnings comes and pass, and it's exactly like the scenario you were just explaining. The IV was too hot. The earnings, what they do, they missed on revenue in July, they beat on revenue, missed on earnings. So you got this big washout, right? And then at that point, all the traders that you're talking about, they're trying to front run this binary event, think they're smarter than the market, they capitulate. All of those calls drop off. At that point in July, I bought a bunch of calls because they had fallen off so dramatically. Then the next Monday, it gaps up, you get a quick 3x, right? So it's just like there's that risk or the inverse of it. So everybody piles in ahead of the event, then they capitulate, and then you get that kind of spring back. So that's an easy way as an options buyer. If you wait, like you don't necessarily have to sell if you don't have a lot of capital. You can wait for those kind of high RV events to come pass, and then you still get the spike back after you collect quick gains. The earnings in October were basically the exact opposite. The options market was priced relatively cheap because they were expecting what happened during the last earnings to be a repeat, and then it goes ahead and beats and goes up.
And the interesting thing about that is some of the new traders that didn't really understand because they bought into the Tesla contracts. It was a 1,000% gain or something of that nature. It was insane, but they took it as it was a one-off. It wasn't a one-off. It was a strategy. That's what we want to convey. It was something that is repeatable. Is it always going to win out? Of course not. That's not what the statistics say. But to catch a run like what happened there on Tesla, it's something that can be repeatable. Can it happen again? We don't know.
That trade, that Tesla trade that we took last year, so that was October of last year, right? It was ahead of the earnings, and we bought December calls, the money calls. Had nothing to do with the earnings. It was the fact that you looked at it, you saw one catalyst, the earnings, right? So that's something that could prop up the stock. Two, if you looked at the poly market odds of Trump winning the election, they were steadily on the rise, right? So this is like part of the probabilistic thinking. See the close proximity to Elon and Trump. Is there any scenario in which Trump wins the election and Tesla stock crash at very low probability, right?
Right.
And if somebody's selling you that kind of upside for that cheap, with those kind of catalysts on the forefront into the end of the year, you take that bet, right? It's all odds.
Yep.
So did I know Tesla was going to go from 200 to 500 in 2 months? No.
No, of course not.
No. If I would have known that, I would have bought a whole lot more, of course.
Let's take mortgage on the house.
That's just the thing.
But I'm playing the probability, right? If somebody's going to sell me that kind of upside, and I have my own analysis, and I'm looking at this, and I'm like, well, okay, the stock's down for 30 days in a row, and then there's this big absorption. We're heading into all these events that could possibly propel it, and you're giving me that upside for cheap. Yeah, I'll take that bet, right? So it's like knowing if you finding your edge, number one, and then applying it in that way that's repeatable. And for the like, can you allow a bet like that to take you out of the game? Can you put your entire life savings into it? No. But if you keep that size low enough, yeah, you're going to get 200% gain sometimes. Like it's crazy. So you know that you find your edge and you hone it and you repeat that process enough times, you're going to get those big winners in the options team.
And that's where I think we come into play, right? As coaches and as a group,
Teaching people, right?
will help you find your edge, right? I'm not force feeding my strategy down your throat and saying you have to trade the bag indicator, you have to trade the EMAs and trend. No, but I'm going to show you why it's successful for me. And if you like a piece of it, you guys already talked about it, right? I call it duct taping strategies to get it. Part of Shane's strategy, part of Kyle's strategy, maybe some Shane strategy or a Sage strategy comes in here. I'm going to duct tape it all up, and this is now my new strategy. It works for me, and I like it.
You can find infinite opportunities like this in the market, right? So it didn't have to be Tesla. You could start honing in on any specific field, say nuclear stocks, right? Like say you're really into nuclear research, you have some kind of edge that the market's not pricing in. You see that kind of depressed volatility in the options market, and you feel like there's catalysts coming up. You can take the same strategy and be like, hey, I think this is a great time to take risk reward on out of the money options with some time, and you're going to get those kind of big wins. But you have to study and hone your edge. But it's the same thought process, just applied to different things over and over and over.
Usually people do a lot of false starts in trading. I'm less susceptible to this now, but I want to be in something. Timing it is sometimes a little bit more difficult, but for newer traders, you just got to make sure that you're looking for several factors of confluence. You found that on the Tesla trade, did you not?
Yeah,
You have
confluence all over the place.
and it wasn't just technical confluence, but
It was a little bit of everything. That like there's
exactly
no
right.
one.
I say this a lot in my sessions. I actually want to bring up an alpha member as well, because he is naturally a pessimistic person. We don't have to go into who he is, but you already know who he is. So he's a natural pessimistic person. But our job was to convince him not that we are right, but that the strategy that we were showing him based on the confluence factors are what determine whether he takes the long or the short position. Made $4,000 in a week, right? Going off of that. And then he comes back to us and he's like, it's not really one thing that clicks, but it's just being proven that it can work if we are following the steps that we need to follow. And if it's invalidated, it's invalidated. Fine, no big deal. And if it's a loss, okay, it's a relatively small loss, unless you're swinging. That's a different situation. But he understands that now as a scalper. He's using more Kyle's strategy, right? So we all know what we're talking about. I don't want to put him on blast. But that dichotomy between maybe knowing something, knowing that the moving averages, are an indicator that we use, and actually using them in real world scenarios is our job, I think, as not just traders, but also as educators, right? Because that's kind of our focus, just educating people on, okay, cool, you take this trade, but did you understand some of the stupid stuff that you did before? And do you see a natural progression in what you're doing now, right?
Mm-hmm. That's the game, man.
Yeah, and that's why it's just so crucial. I know I talked about it just a couple of minutes ago. It's just so important that whatever your criteria is, it has to be the same over and over and over. So you have accurate information from the past and you know what's working and what's not working. And there is a time to make that shift, right? There is a time when you start to can something like this just isn't working. I need to make a shift, but it's not after one bad trade. It's not after one loss. It's after a while of it. So,
and you know what, Kyle? People are going to watch this and going to be like, okay, they're not revealing their strategy. Yes, I mean, we really are. We really are.
Yeah, I mean, where to tell you, my cards are on the table.
It's kind of how I feel about it as well. Because it's usually behind a paywall, a pretty big one. But like, I literally broke down my strategy, and so did you, and so did you. So like, people think it's this one thing, this one indicator, this one thing that you do, and you just do that repeatedly, and it's always going to win out. No, it's not. It's not that one indicator. Moving averages is what I like to use, right? I like to use the TTM as well. I like to use some sort of oscillator, some sort of
the confluence. You know what I mean? Yeah. You need to
have what it is. It's the confluence, and you have to be able to have the experience built up after not a couple hours. In my case, thousands of hours, but it's not something that you just learn in a short period of time. It does take experience. That's why training is so difficult. It's really
pattern recognition, right? And you can't recognize patterns unless you spend time analyzing it. Like
exactly.
You have to put in the work. You have to study it, but those patterns will reveal themselves. That's all you have to like.
And it's usually a pretty good idea to study price action historically, or just study patterns on the larger time frames, usually weekly, and just study the swings and sort of confluence factors of what happened last time. Last time that we had tariffs, last time that we had a COVID level event, which I've never traded through, but now I have more experience with that, right? I didn't have that experience before. I don't have the same experience that I'm, gaining with you guys now, right? It constantly is something that you're just learning and adapting towards, right? That's how I feel about it.
Yeah. So in summary, right, just to kind of put a nice little bow on this topic that we're talking about, we shared each one of our insights on our strategies, right? What they can expect from us individually, but there was some themes amongst each of us, right? We have set criteria for certain trades. We are disciplined in our position sizing. We understand what our risk reward is for every single thing. And we're not at HighStrike. Like if you come join HighStrike, we're not going to shove this down your throat. We're just going to teach you what's important, and we're going to guide you on the path and hopefully shorten that learning curve for you to find what works for you.
Exactly.
And I know we can get testimonies from people that are in there, because off the top of my head, I could think of like 4 people just off the top of my head that started with me with the EMAs and with the trend, and now they're doing something totally different, but it works for them. And I don't know if they would have gotten there if it wasn't for our alpha sessions and our morning sessions and our power hour sessions, where no, we weren't just talking about our strategy. You're talking about markets in general that can apply to their strategy, how now they're seeing this.
Shortening the learning curve.
Right? Like if you go into MMA fighting like you used to, or if you're a baseball player like I used to be, or if you play an instrument like you do, how much easier it is if you have a coach.
Exactly.
Versus you going, I mean, sure, you can go on YouTube and try and learn it, but you won't know if you're making a mistake until you have a coach that says, hey, you have an right to this. Your coach might say, hey, you should tweak this thing right here, do something a little bit differently. And that's where I think our value comes in, is no, we're making signal discords where we're going to spoon feed you signals and you're going to thank me when I make you money. Like, I don't care about anything. What I care about is the people that came in, put in the work, wanted to learn, and now they're getting it on their own. Yeah, those are my favorites.
I've noticed this. No one gives a shit that I made $100,000. No one cares.
Because it's not their money.
Exactly right. Exactly right. So I noticed this. I'm like, okay. Like I scalped. I think I scalped on Friday. I shoved the long. Yeah, I took a long on the 3 minute. I made $27,000.
Mm-hmm. Okay, nobody cares.
No one gives a shit. I give a shit. I give a shit, but no one else gives a shit. It's kind of like, all right, you post you have a nice car and you have a nice house and you have a really nice wife, right? It's beautiful. Who cares? It's not mine. So who cares? So really, what we need to focus on is, okay, we're using the moving averages. We're all using it a little bit differently, but what that execution is with using those indicators, the same ones that we all use, How is that going to be a little bit different than maybe Joe Schmo that's jumping into trading for the first time, right?
I think a lot of people fall for that kind of cult of personality type thing that you get with a lot of trading groups, where you have somebody out there who's flashing a Lambo or
Rick and my Lexus, $10,000 in Vegas.
and then they're going to tell you, oh, well, I made $1 million, and you're like,
I had one person say this. I'm sorry to cut you off, Shane. Go ahead.
oh, go ahead.
One person say this: whenever you see someone's luxuries, you're looking at their expenses. You're not looking at their wealth, and that stuck with me, right? Because I grew up with a Jewish family, very wealthy Jewish family, and for me, I was always like, "Where's all the expensive shit? It's not around the house." They had a nice house, they had a decent car, they had a nice little Cadillac, and then my mom was like, "This guy's, its net worth is $8 million." I'm like, "Bullshit."
That's have a Lambo. I was 8.
No, I couldn't believe it. I couldn't believe it. I swear to God, I couldn't believe it. But then I started putting the pieces together, and I'm like, okay, all that stuff is flashy, it's great, but you're looking at expenses. You're not really looking at wealth. I mean, there might be, of course, but you don't want to draw that kind of attention. If you are actually making money in the market, it usually is in the market, right? Majority of my money is in the market.
Yep.
A little bit in my savings, but that's basically it.
Somebody asked me what my biggest flex is, right? Because I don't post Lambos, I don't post Rolexes. You know what my flex is? My kids' college is paid.
Yeah, of course.
My kids have a trust fund. I took care of my family. That's my flex. And no, it's not flashy. And no, maybe it's not relatable, but it's a huge accomplishment that I'm very, very proud of.
It's all memberships.
I bet on Instagram and flash the rollie or anything like that. But I will flex on that is my flex on anybody. Like that's my biggest accomplishment is being able to say I took care of my family, and that came from trading.
Yeah. And I think like in today's social media, like there's no shortage of people out there that are going to flash make-believe paper wealth, right? And tell you, oh, well, look, I made $1 million trading yesterday, right? Follow me. But how sustainable is that? Like, how much money are they actually going to make? Are they going to teach you anything? Or are they just going to tell you, oh, I took this position 3 days ago and I made $1 million, right?
I got lucky and never said, well, can't repeat this. I don't have to show
There's no shortage of that. And I think that's what we want to separate ourselves as, is people that are actually going to teach you, right? Like, it's not going to be easy. It's by no means easy, but if you put in the work, you're going to see the results.
Yeah. We're super transparent. We have nothing to hide behind. You see all of our trades, all of our results. Like you see everything with us. We know that more often than not, it's going to be profitable, but there's going to be weeks like this week, it wasn't profitable for me. Like it just happens. It's a part of the game, but I can promise you when I get back next week, it's going to be different. It's going to be better.
I had one guy, he's like, how did you not know that Trump was going to sink the market? And I was like, well, we jumped pretty heavily when he announced that he was going to win. Also, that he was leading in the polls. So
Market front ran it.
yeah, we front run our state of the PA. Yeah, and then I usually say that it doesn't really matter. It doesn't really matter what's going on, what really your affiliation is via your opinion. You just have to trade the charts. Mm-hmm. And if it's not working, it doesn't mean that you jump ship on your strategy. You just got to double down on studying exactly what went wrong and how not to do it, or how maybe to do something a little bit differently. When
people that were telling you NQ is going to go to 30,000
right
2 months ago are now telling you we're headed to a Great Depression.
Now they're saying recession. They're calling out.
It's the nature of markets is that people are prisoners of the moment. And if you can learn to study things in patterns, you could see the truth is always somewhere.
I've noticed that. I've noticed like I'm a little bit more of a creative person, but a lot of people, and you're not that creative. So
Zero creativity.
But I can see in my mind's eye, like an image of something, and I can tell a little bit of the future sometimes. That's what it feels like with trading. Some people just don't have that. Some people only see in the moment what's going on now. Some people right now, well, when this video comes out, can say, no, these guys are completely wrong. The market's not going to be bouncing back anytime soon. We'll see. Yeah. We'll see. If it doesn't, then we're not going to air this video.
December season life dip. But I also think that to your point that you can have that creativeness like you're talking about, and you can be rigid and black and white like I am. Like I don't bend or anything on my strategy. Mm-hmm. And everything has to be A, has to go to B, has to go to C, and I'm successful at trading like it. You can also be a little bit go with the flow, right? A little fluid with it. No, not go with the flow, but be a little more fluid with your vision that you're talking about, where the trade can be a little bit outside of the box.
That comes with so much time.
Yeah.
Like that comes with a lot of discretion and a lot of being able to see things, right? But if you're just starting out, you need that rigidness. Like a new trader cannot be fluid. Like you can't have too much discretion as a new trader, because it comes with a lot of years where you could be like, okay, I can feel something now. And that does come, like that intuition is real, but it takes a lot of you can trick yourself into thinking it's that. Are you experienced enough to know when a move is position driven? Right? When too many people are in a position and it's causing max pain, and then that reversion is going to happen, right? Like most people aren't. And if they bet like that, they're going to lose.
I'm in a group, to Kyle's point, where there's a girl in there and she's like, should I buy AMD calls? Because I kind of feel like it's going to go up, and that drives me insane. I'm like, yo, I think AMD is.
Maybe we're entering a recession.
Right.
Don't you know?
I want to buy more AMD, but the market isn't pricing that in, and obviously there's no momentum there whatsoever. But the way that she goes about it is more the touchy-feely aspect, where she thinks it's going to go up.
How long have you traded? What kind of returns have you
Yeah.
That intuition, you can't teach somebody intuition,
No,
but
you
it comes with time,
Mhm.
right? And there is an element of intuition that comes in over time.
Mhm.
But you had better have the results to prove it.
Right.
Right? Like if you bet on an intuition that isn't there,
You need that foundation of the rigidness
Yes.
before you can
expand.
the intuition part of it. Yeah, you need that base, because if that intuition fails you, like maybe it works for a little bit, but then it starts to fail you, you go right back to your foundation and you already have
Yeah.
it.
Yep, that's exactly it.
And it's usually statistic based. Businesses have performance reviews of how they're doing, their sales part, their whatever department. We need to have that as traders as well. But we don't hold ourselves accountable to those kinds of numbers because we just don't feel like it, or we don't have that structure, or we don't have that discipline in our trading, because we don't run it like a business. We treat trading like it's this one thing. We see people making a little bit of money, and we think that they don't put in the work. They put in the work, right? Those people put in the work.
There's nothing that comes easy in trading.
Yeah.
If it comes easy, it's easy come, easy
Right,
go.
right, and you will be knocked off. I think that the worst thing that can happen to a trader is hitting a big trade early on. I think it's the worst thing that can possibly. It happened to me.
Yeah, you said that for like 5 years. I know you've been saying that forever.
It happened to me. I made 80 grand in a trade,
Because you think you can't lose.
and I thought I was
You're
hot
oh,
shit for the biggest
this is
time.
easy.
Mhm.
Yeah.
I was like, yo, screw everything else. I'm just going to start trading for the rest of my life.
Yep.
And I gave it all back slowly, but I did give it all back.
Yep.
Then I started to realize when I was like $250, almost $300,000 down, I got to do something a little bit different. I'm not as hot shit as what I thought. 80 grand in one trade when you're like 21 years old, it'll do stuff to you for sure.
Oh yeah.
You know what I mean? It will definitely do something. But yeah, that's how I learned. I was like, I probably need to invest in actually what I need to do, right? Because I can't just hit that one off because I'm that good. It doesn't work that way, right?
I bought Bitcoin when it was $600 and Ethereum when it was $8. About a year before and I felt like a damn genius.
How do you feel right now? It's near 100,000.
But I mean, then it all crashed, right? Like, it is what it is. But like, for that year there, I was like, I'm the smartest
person on planet Earth. Yep.
Can you imagine the product of the bubble? How many GME millionaires, Doge millionaires, right? Like
At one point. Yep.
And they did not take profits and they gave it all back, right?
I think about that a lot. I think about how many people have hit it big. Probably millions of people that hit it big at the right point in time. Like my mom, when she got to this country, I told her, if you put just a little bit of money just in the .com stuff, you would have been way better off than what we were. She never did. But who cares, right? Who gives a shit, right?
And that's the part that comes with time too. Like the beautiful thing about crypto too is I've lived through multiple bull and bear cycles, right? Like the extremes of both ends multiple times. So you get a glimpse of this and it's like, by the time the 2020-21 bubble came, I'd already seen it before.
Right.
I'd already lived through the boom and the bust. It's like, okay, I know this plays out. You have a window here where you can basically just take as much money as you possibly can from the market, and then that's it. It's going to be over. I didn't know how it was. I didn't know if FTX was going to collapse, but I knew when the Fed started hiking rates in 2021, late 2021, like, okay, that's your get out sign. Like, it's over. It was a nice run, but that's it. But if you're not accustomed, like if you haven't lived through cycles, it's going to come for you. There's no escaping that. But the lessons you learn, if you could stay alive, then you get the polar opposite and things go on extreme discounts. And if you can spot that, then the market's always going to give you another run,
I think that's another unspoken value of not just the HighStrike trading room, but trading rooms in general, that, they kind of have a bad rep, I think, for most reps. They're toxic, right? There's some bad rooms with bad apples in every room.
The majority of they're to pump and dump, right? Like that's an under the
thing that I like about it is the point that you just made about how you've lived through those cycles. So why not get somebody who's lived through those cycles on my team and can talk with me about it and help me through it, especially if I've never done it? Why wouldn't I partner with those people and at least pick their brain on it? Yeah. So I think that's another value for the trading rooms that we have it. And yeah, HighStrike, I'm biased. I think that we have the best trading room.
Well, how many trading rooms out there are explaining the dynamics going on in the bond market right now? Agreed. So how many?
No one is talking about the bond market.
That's a great question.
How many people?
We don't stop talking
Sir,
about the bond market.
how many people out there actually understand these dynamics?
No
right?
one understands
They
that.
don't understand it. But it's all about like what's happening right now in the market. They want a measure of deflation,
Mhm.
which by nature is wealth destruction. When you have NQ crash 10% a month, that wipes out a whole lot of paper wealth.
Yeah,
Right?
absolutely.
So that's money being deleted from the supply, which is what Secretary of Treasury Besant's been saying since he got in office. We're bringing the 10-year yield down. The only way you do that is by a measure of deflation, which is happening. So it's all ultimately long-term bullish, right? Like you get the 10-year yield down. That's going to allow small businesses to borrow at cheaper rates. Small businesses can grow. You can see things like the small cap index, RTY, IWM. That's all. That's going to have
You know, it's another metric that's interesting. Mortgage rates are coming down as well.
Yeah.
That's another
It
market.
unlocks new buyers.
Yep.
For everything. Like it's not just mortgage rates.
You don't learn that on Robinhood trading 0DT.
No.
That's not there.
Yeah, this isn't your average single group. So we can teach you the underlying dynamics of the macro markets that, I mean, I've studied this for over 5 years now. Like it's a lot of time and effort. And to understand the nuances behind it that most people just don't, you know, you're looking at price, you don't understand what's driving the price.
And you know what's funny? A lot of, I don't know in your experience, but a lot of the institutional traders have become retail traders, and the success rate for those people that understand how markets actually work cyclically, excuse me, they're pretty high. There's a lot of traders out there that are not doing, you know, the gimmicky sort of trading style, and they're doing quite well. That's basically most of the middle class that we have.
Because that's where the alpha is. Yeah. Right. So like if you looked at NQ in December, right? Like post-election, the dynamics we were talking about earlier. Before the election, you had the VIX high above 20, right? There was backwardation in the VIX. So it showed you some level of profit taking, people selling longer term puts. That's kind of a sign of institutions beginning to sell the further out the money puts and ultimately put in a bottom. At NQ at major support. Everybody's prepared for this nightmare outcome at the election. The nightmare outcome doesn't happen. So what happens is the shorts have to unwind. So everybody that's crowded in expecting a crash on election, they have to cover those shorts. Then at the same time, price starts going up because they're covering the shorts. You start getting negative gamma pulls, right? Then retail traders come in. Robinhood trading volumes go through the roof after the election. So it was all kind of this perfect scenario where you have this big euphoric blow off. But if you were looking at the macro, inflation started going up in September. DXY was climbing up. Liquidity levels in markets were shrinking as prices were going up. So it was all telling you it was unsustainable in December, right? But things can obviously remain unsustainable for long periods of time. But this kind of reversion back to just, we're only at the 200-day moving average.
Exactly right.
Indexes, right? So it's
Some
like
people are calling doomsday. It's a 10% pullback.
we're going to see a pullback at one point.
Eventually. And what
Kind of go deeper, sure, but like you're going to see this pullback.
And what did I say about positive expectations? We never meet them in the market. If it happens, it's a one-off, and that's what people stick with in their head. It happens 10% of the time, and then all of a sudden, that's what's driving up the price. Specifically with companies that are usually not long-term sustainable. It's what happens with a couple of companies that we just saw recently. Sorry to say, MSTR is one of them. SMCI has been another. PLTR has been another. HUD, more or less. Coins
Things can't sustain that rate of change forever.
No.
Right? MSTR went up what?
NVIDIA's an ever example.
500%?
Right.
And it's exactly what we were talking about before, is that you have people crowding into those positions, right? Well, it's going to go to 1,000.
Right.
Well, it is going to go to 1,000, but it ain't going to 1,000 next month.
Exactly.
You've already missed the move. But at the point when people should not be buying options is when they want to start buying it, right?
Exactly right.
And guess who's on the other side? Sage, institutional traders. They're saying, hey, you're going to buy this $1,000 call from me for whatever. You're going to pay me $2,000 a contract. I'm going to sell it to you because I own the shares, and I'm going to harvest all that volatility. And then when it bottoms out, I'm going to buy it back.
That's the uncle at the Thanksgiving table. When Uncle Randy's at the Thanksgiving table and says, "I want to buy an Nvidia," I'm shorting it.
So
If everybody knows about it, it's time to get short.
To be a little bit more technical, I don't buy at all-time highs. I just don't do it.
No.
I don't do it. I don't ever do it. I have probably maybe twice in my career have I done it.
you have to see the setup for all-time highs coming beforehand.
Exactly.
Get
That's
into position.
that
If
is
you
such a good
ride
point.
it through new all-time highs, that's one thing.
That is
Don't
such a
buy.
good point. I usually want to buy in when no one else was or does. I made a huge bet on China. You guys know this. I just want to tell the story here. I made a huge bet on China when no one said that China was gonna relieve itself. There's no stimulus package. There was nothing, and I made the call. I'm making the call on the bond market right now. We're going to talk about the bond market shortly, but I made the call on China. It's been probably one of the best trades I've ever made. I made the bet on semiconductors when no one wanted to get into semis. I made that call. I made almost $400,000 just on semiconductors.
Because you zig when others zag. That's the nature of the game.
Exactly what happened. And then I was looking at everything, and I didn't know that the CHIP Act was going to come out. I had no idea. But I knew that AI was the new thing in 2022, November. So I said, okay, so with AI, there's going to be a lot of mining going on, and we're going to need more chips, and we're going to need to just have manufacturing specifically in that space. So I anticipated the price action. Did I know that, my trades are going to, 10x?
Who knew NVIDIA was going to tax, but you knew the odds of a bottom being over there, right?
Of course. And
It's all the institutional accumulation. Like there was the signs there. If you know where to look, that's what we're here for, right? It's like, here's what an institutional accumulation zone looks like.
Yep.
It's exactly what the NVIDIA chart looked like in fall of 2022.
So you didn't catch the NVIDIA run? Well, we kind of did.
SOXL.
We kind of did. I did.
NVIDIA was the horse that dragged that thing up.
So I kind of did.
But where was SOXL when you bought it, right? It was
$8.50.
because the bubble had burst, right? Like back in 2022, same way they are now, people were calling for recessions. It's all over, right?
And I do it maybe once every 2 years. I did the same thing when SPL, what was the bank that imploded in California?
Silicon Valley Bank.
The Silicon Valley. I did the same thing. I bought into banks, and I bought into them pretty heavily. It's not that hard. You just got to wait for it. You got to be patient enough. Sometimes we're waiting on 2 years on a trade.
You also have to have bravery.
Yeah, you have to have some balls.
There's some courage comes with that as well. Yeah, you got to have a little bit of courage to zag when everybody's easy to be swinging with the fish downstream.
What we're saying, like, if you know what's happening in the macro, exactly what we were talking about with the bond market, right? Like, what started to happen in September 2022 is they started to release a whole lot more treasuries into the market, and essentially, as the government raised more debt via the bond market, they created an overabundance of supply. There wasn't enough demand. So interest rates went up, liquidity went up, inflation went up.
And that demand.
And all the institutions said, okay, you're going to print this liquidity. Guess what? We're going to buy NVIDIA. We're going to buy all these tech stocks because they're going to outpace inflation. So at that bottom, while everybody's calling for a recession, they're not paying attention to the macro.
Exactly right.
They're not seeing all this liquidity coming to the system. That liquidity by mandate has to outpace inflation. They weren't getting in bonds. So they all piled into the NASDAQ, right? And then we see this huge run up in the NASDAQ. What's happening now in the bond market is it's normalizing. They're bringing down the 10-year yields, right? So the government says, we're taking away all these government jobs, all these cuts you see with the Doge and whatnot. That's all centered around lowering inflation, normalizing the bond market, bringing yields back down. It's all long-term bullish, but it's going to cause a little bit of pain and turbulence here in the short,
which is what's happening.
Short term as we see.
We had it actually, I believe it was 3 data points away where I think the bond market hit its top for about a 52-week period. And then after that data point, then we just sold off. Right now, it's starting to accumulate in the right area. So the 10-year, we went from, let's see, early January, it was at 4.75. Right now, it's sold off back down to almost 4%. So there you go, in such a short period of time.
Yep.
Right.
It failed to maintain that breakout above the 2023, 2024.
I'm looking at the daily right now, but daily, weekly, same thing. These fluctuations on just the percentages are massive. They really are.
They could not make it. Like, there's that old adage, right? You don't fight the Fed. You don't fight the Treasury. When the Secretary of Treasury is telling you, I don't give a damn about the markets. The only thing I care about is bringing down the 10-year yield. If you understand macro, if you understand the things that we teach people, how do you get deflation? You delete paper wealth. And that might mean the NASDAQ goes down by another 2,000 points, right? But ultimately, if that happens, it creates a scenario that they want. They want deflation so they can lower interest rates, and that allows more liquidity into the system and everything. Maybe not your tech, maybe not NVIDIA and whatnot, but it will find a home in undervalued companies. So small caps can get all the liquidity that was preventing them from growing in previous years. If you look at the Russell, the way it underperformed the NASDAQ for the past, basically since the 2021 peak, the Russell hasn't gone up. Why hasn't the Russell gone up? People have been pulling their hair out wondering why small caps don't go up. It's because the interest rates were too high. So NVIDIA, Apple, et cetera, they're all cash-rich companies. They have tons of cash on their balance sheet. They can grow without issue because they have a lot of cash flow. Small businesses don't, right? So small businesses need to go into the debt market. They need lower interest rates so they can borrow and outpace the rate of borrowing with growth. You can't do that when the interest rates are 4 or 5%. Interest rates come down to 3, 2%. Then they can borrow that money at that rate and grow faster than 2% and make a big boom in small businesses, private businesses. Like, this is the setup for kind of a real golden age in the economy. It's just going to take a little bit of short-term pain.
I understand that to be something actually actionable. Like, that is investable, what you just said. I'm just waiting for the right time. I'm looking at the chart, and I don't want to give too much away. But
the bottom could fall out, right? Like, deflation could happen pretty rapidly as we lose.
But I know where the bet needs to be.
Yep.
Just by saying that. I know I'm looking at it, and I know exactly. Well, I already have my own opinions on where IWM can go, but I don't want to put that energy out into the world. But
it could go a whole lot higher. Let's just say that.
But
Can I interject here?
yeah, go ahead.
All right, hold on. If you like what these two gentlemen, these intelligent human beings are saying, use promo code KyleM for HighStrike Trading in right now. 50% off your first month.
No, but understanding the macros and the correlations between those macros and how they offset one another is where you can put your money in for long term. Generally, what I think, and I made these decisions about 10 years ago, about 2 to 4 years, and then you can grow that wealth there. I remember the first time I made 100 grand, I was like, holy shit. So this is what I can do now. And I could just park some capital for a little while. I made a lot of money on Adobe. I bought it at $78, and I bought a lot of it too. And then from there, it's just about being cyclical. Usually with my trading, there's a cyclical nature of about 2 to 4 years. And I'm rotating out of positions. I want to do that now with the bond market, but it's not really helping me out that much.
There's a statement, you made a comment about the first 100K. I read something a while ago that really stuck with me. They say the first 100K is the hardest 100K to make. And I believe in that firmly, because what I think what happens in that first 100K is exactly what we've just been talking here for the past 40 minutes, right? It is that trial and error. It's that hurt. It's that pain. It's finding your strategy. It's finding it works all. And then by the time you reach that 100K, you probably found something that works for you. And now it just compounds and snowballs.
You've proven to yourself that, because 100K, like, I'll be honest, I'm going to be perfect. I'm going to sound like an asshole saying this. Is 100K a lot of money? Maybe not to someone like me. If I lose that, which I am down more than that since the beginning of the year, okay.
It hurts. It hurts. The game isn't over.
But it's not the end of the world. But for 99% of the traders, 100K is life-changing money. It is literally the difference between you thinking that you are impoverished versus you actually having some capital to do something with, get an education, buy a car, buy a house, down payment for this, whatever. So yes, 100K. I don't think that the milestone itself for the 100K is the significant part of it. It's the process in you actually making the $100,000 and proving to yourself that you can actually do it. The 6 figures, the 5 zeros after the 1, is the significant aspect of it. If you can make that 100K, making $100 million shouldn't be all that different. Maybe $100,000 or $100 million is too exaggerated. Maybe $1 million.
That's all everybody in Q4, right? So like if you ran up, so I have this habit with the options account. If I run it up to 100K, I bring myself back to 30. Because if you can do it once, you can do it again and again. So why even give yourself the opportunity to gamble it away?
I usually tell people,
salt that away and do it again.
If you can double your account 5 times over, you're ready. You're ready for anything.
The compounding interest, the calculator that you share is double your account 5, 10 times.
That's it.
You just changed your life and your family's life.
You don't have to do anything else. If you can double account 5 times, you are ready for anything in trading. 5 times. That's your challenge, right? For those of you that are listening, 5 times over, you can do anything. But also, you got to try to maintain at least some of the capital. Don't blow 13 accounts.
You can't try to double it
too quickly
in one trade, right?
It all comes down to that strategy, that risk management, that position sizing. Yeah, doubling it 5 times the right way.
Especially like this is the hardest part, because in conditions like this, right? Like the market can get a whole lot more irrational in the near term. Things could totally crash, but the opportunities that will, like, if you stay alive, right? Like that bounce back, man, when all of this liquidity comes into the system, it's going to be there. And if the bottom falls out, the kind of opportunities you'll have, especially in options, like that is how you can get those insane gains. But if you try to blow it, calling a bottom too early and full porting yourself, it's over.
It'll take all your pain away.
I hear this all the time. I keep on buying the bottom, but it keeps on dipping.
Seeing those memes, bottom, but it's worth bottom.
Yeah, but the euphoria that will come from being smart with your position sizing and being able to be around for that. We always talked about it, right? You got to be funded to still keep trading.
You got to stay in the game.
You can't blow it all in a single trade or in one, and you just can't do it. You got to stick around, and you got to do that through proper position sizing, and we can help with that too.
And usually, 10 years teach you what the days never know. That's usually how it goes. So it's kind of difficult for newer traders to understand what we're talking about, because we all have collectively, I think between us, maybe 40 years of experience between all of us.
Yes. Yeah.
I think between all of us, it's about that. So when I listen to you guys, I'm like, okay, I wasn't really thinking about it that way, but it's really good to have opposing ideas and thoughts. And like, I have fundamental disagreements with, like, let's say you said that Tesla was not going to trade back down to like 250, right? You said that at one point, and I disagreed with that. But it's not that I disagree and, it's about who's right or wrong. I don't care about who's right or wrong. We're just going to see exactly where we can take it, and then from there make a decision. Yep. That's it. That's all it's about. I don't care about being right. I care about, if I am wrong, at least I can stay alive. That's what it is.